Good morning. It's great to see all of you again today. Today we have a very special guest starting the day. Jason Huang is Senior Vice President, Strategic Planning and Research at Federal Home Loan Bank of Boston. He oversees the bank's strategic planning process and provides management and the board of directors with financial forecasts and assessment of strategic opportunities and risks. Jason also supervises research into the bank's performance and broader banking industry trends. He holds a PhD in economics from Harvard University and speaks frequently about the economy and Federal Home Loan Bank of Boston throughout New England. So Jason, thank you so much for being here today.
Thank you very much, Madam Chair, members of the committee. It's an honor to be here with you this morning to discuss the economy. So thank you for having me. So I'm here to provide economic update. And let me just quickly go through some topics for today. This being my first time coming before this group, wanted to just tell you a little bit about myself and the organization I work for. And then the main topic of the day, wanted to focus on inflation, that being the critical driver of economic performance this coming year, and key policy choices that the Federal Reserve will have to make. All depends on what happens with inflation this year, so that'll be the focus of my comments today. So I list here kind of 6 things that have contributed to kind of the very high levels of inflation that we've seen. So just to give you a quick preview, what are the 6 things? Supply chain bottlenecks, that's number 1. Number 2 is the war in Ukraine, leading to a big increase in energy prices. Number 3, relaxation of COVID restrictions leading to a surge in demand for travel. Number 4 is household savings becoming very high during the pandemic. Number 5 is home prices. And number 6 is labor shortage, which I know you discussed with some of the state labor economists yesterday afternoon. So I'll make some comments about that as well. And then I'll make some comments about Federal Reserve policy and provide an outlook on the U.S. economy and make some comments about the New England economy. Okay.
It looks like we have a question up front. Representative Platt.
Yes, I noticed that you didn't mention the amount of cash circulating. The inflation is from overspending by the federal government.
Yeah, I'll come to that. I think that'll be related to the topic of excess savings that we'll come to.
I would remind members that this is not a place for you to make statements about your beliefs. This is a place for you to ask very polite, clarifying questions of our presenters. Thank you.
Thank you. Yes.
Representative Phyllis.
Yeah, I'm just wondering if you're going to, or can you define what you mean by inflation? Is there a particular metric?
I certainly can, yes. Can I come to that in 2 minutes?
Sure.
All right, I'll start my remarks on that. Let me tell you a little bit about myself. So as Madam Chair just mentioned, I am Senior Vice President of Strategic Planning and Research at the Federal Home Loan Bank of Boston. And I get to do this at industry events and with our member institutions throughout New England. So the organization I work for, I wanted to just tell you a little bit. In 2022, last year, we celebrated our 20th year anniversary. We are a wholesale bank lending to member institutions throughout New England. And it just happens that the longest member that has been with us and has been using our services is a New Hampshire member, a Salem Cooperative Bank, and they've been a member of our organization for almost 90 years, and soon it'll be 100 years. So on the next page, you see here the institutions who are members of the Federal Home Loan Bank of Boston, just about every community bank, and many of the larger credit unions and many of the insurance companies are members of our cooperative, and they use us for their liquidity and funding purposes. And many organizations use us for affordable housing programs as well and community development. Okay, with that background out of the way here, let's get to the topic. So very good question. What do we mean by inflation here? So when we talk about inflation, we're talking about the general price level. So when we talk about the general price level, we're talking about households' consumption baskets. So each of us represent a household, and we all have consumption baskets. We consume goods and services, goods including things like food, apparel, things that we buy, services like medical services, transportation services, and things like mortgage payments are considered services as well. So all those have price levels associated with them. And economists at the Bureau of Labor Statistics work hard to bring all those prices into a single metric. And that's the general consumption price index. And then when we talk about inflation, we're talking about how much did that general price level change year over year. Did that help? Great. Okay. So on that point, before at 8:30 this morning, right before we started this session, there was the newest consumer price inflation report was released. And I don't know if you're like economists looking for this report every month, and 5 minutes in, you've kind of reviewed all the data. In case you have not, I was looking for this report and I saw it right after it came out. Let me just tell you that there's good news. So consumer price inflation peaked at 9.1% in June of this year. The latest reading for December is 6.5. So it's been trending in the right direction, but arguably it is still too high. And the question is, how quickly will it come down to the Federal Reserve's target of 2% inflation per year? So that's kind of what I want to provide some perspective on. On a core basis, because prices of food, prices of energy can be quite volatile, sometimes the BLS will track core inflation numbers, excluding food and energy prices, and that came in at 5.7% year-over-year change, an improvement over a peak of 6.6. So headline inflation has come down from peak numbers earlier in the middle of last year, and then on a core basis, inflation has come down as well. So encouraging signs, but these levels are still much too high. If you talk to any of the Fed officials, the target is closer to a 2% level. So anything above 5 or 6, or those are very high numbers, and they're looking to bring those numbers down. Okay, so to provide perspective on how these numbers are trending, whether we're likely to see substantial moderation in inflation numbers, I thought that it might help if we just walk through each of the reasons why inflation has been so high over the past year, and then kind of look at some data that might point us to some trends and that could help us notice some patterns. Okay, so let's start with the first reason here, which is the supply chain issue. In the middle of 2021, I, like many Americans, was working fully from home, working totally remotely, not going to the office at all. And I wanted a little bit of a nicer home office. So I went to a furniture store to buy a new couch. And the salesperson told me, after I pointed out one that I liked, okay, you're looking at 6 months for that to get delivered to your house because the factory in Vietnam is shut down. And even if they come back online and start manufacturing their sofas, it'll take a very long time for that to get here because of the bottleneck in supply chains and delivery times having increased a lot. So one example of that is this news article from late 2021, where outside the LA port, which accepts about 30% of all imports coming into the United States, there were close to 100 ships that were unable to dock and unload their cargo. And so that just, it's like right outside, it's here, the ships have come here, arrived, and yet because of the supply chain issues, labor shortage issues, they were unable to unload their cargo. So that kind of thing, constrained supply, and demand, if it's strong, that'll tend to raise prices of these goods kind of coming into the country. So what's happened since then to the backlog of container ships and cargo ships? So this is a chart that shows the number of ships waiting to dock at the LA port. And again, that's one of the most important ports for imports coming into the country. And what it shows is that throughout 2021, things got progressively worse with the number of ships that are waiting rising throughout the year. And it got to kind of the peak level over 100 ships waiting to come into the port in the early part of 2022, about a year ago when it was at the kind of the worst peak of this problem. But the good news here is that throughout 2022, this problem has really eased. And if you look at the kind of the most recent data points for October, it shows that we've almost solved this problem. We don't have nearly as many ships that are waiting to dock at the LA port. So very good news. And so this is seems like this issue is really in the rear view mirror here in terms of causing supply chain bottlenecks and causing putting pressures on inflation. It turns out that this story is actually part of a broader global story, which is very positive. Supply chain pressures across the world are easing, which is great for inflation. So because this issue has become very important for prices and pressures on inflation, the Federal Reserve Bank of New York has been tracking this new index, which they call the Global Supply Chain Pressure Index, based on two things. One thing is, how much does it cost to ship something? Let's say I have a manufacturing facility in Shanghai, and I finish making something there, and then I want to ship it to the US. How much does it cost? So that's one thing they track. And the other thing is, how long does it take? And so it takes into account things like backlogs at LA ports and things of that nature. So the higher this number, the worse the problem. The higher this number, the worse the pressures on supply chains, and the more expensive it is, the longer it takes to bring goods into the US. The lower it is, the better. The dark horizontal line at 0 represents the historical average. And what it shows is that throughout the pandemic, we've really had supply chain challenges almost from the get-go due to lockdowns in many places around the world, especially in China, where a lot of manufacturing happens, as well as the challenges with delivery and other supply chain issues. And it really peaked in about a year ago in the first quarter of 2022. But again, good news. This problem has been getting better throughout 2022. So delivery time is coming down, cost is coming down. So these are all kind of relieving some pressure on inflation on this front. Okay, so that's the first reason, supply chain. So I think this is good news. If this is the only thing that was going on and this is the only thing that was driving inflation, I think we would not have an inflation problem going forward. So this is good news here. Let's go to the next issue, which is energy and commodity prices. So as we all know, June of last year, 2022, is when gas prices peaked. National average, right a little above $5, and I think it was above $5 here in New Hampshire and then throughout New England as well. The photo here shows California, where the prices are much higher. Okay, so how has the trend looked so far? So the big increase came in the early part of 2022 following Russia's invasion of Ukraine, Russia being a major exporter of both crude oil and natural gas. So there was sanctions placed on them and so on. So that put a lot of pressure on this market, and prices sharply increased in the early part of 2022, reaching a peak just above $5 average across the nation in June of this year. But as we know from kind of watching and then filling up at gas stations, that price has come down quite a bit. And we're right now we're at the low threes. So that's a very positive trend. So there's a downward trend here. That the important thing here, remember that when I defined inflation at the very beginning, it's an annual metric that the Fed is targeting. So compared to the same time last year, where are prices today? So it's not, let's say gas prices today are $3.20 per gallon. So that's still high compared to pre-pandemic, but that's not what we're measuring. We're measuring compared to a year ago, where are prices today. And if you look at this chart here and you track sort of where things were a year ago, we're lower today. A year ago, gas prices were even higher than $3.20 or wherever we are now. So that would represent a positive development. So year over year, gas prices, even though the level is high, the change from last year might be in the right direction, meaning it's low or even possibly even negative. So that would tend to be a positive factor for inflation. Okay, that was gasoline prices. The other important energy source, of course, is electricity. And electricity prices have risen for most of 2022, but they did reach a peak in September. And the most recent data I have are for October and November, and prices did come down for those 2 months. So again, positive news there. Would love to see electricity prices come down further, but at least it's a little too early to call this a trend. But at least for the most 2 recent months, we have data for things are moving in the right direction there, and hopefully we did see a peak there.
Could we interrupt for just a moment for a
absolutely.
question? There's a representative behind you. Representative McGuire has a question.
Thank you, Madam Chair. Thank you for taking my question. A lot of electricity in New England is generated from natural gas, and we're heading into the winter season, so a lot of natural gas gets diverted to heating. Should we expect electricity prices to go up more?
So that's an excellent question. So Representative is exactly right. Electricity prices have a lot to do with natural gas prices. So I didn't show here, but I also took a look at natural gas prices. So natural gas prices do not show a sharp increase as of right now. And what they're expected to going forward, I think it's a little hard to tell. It depends on the severity of the weather, how cold it gets in the winter here in other parts of the world. So far, it's been a mild winter that's helped. So I think that would drive a lot of the kind of the short-term movements. And beyond that, I think kind of the geopolitical things kind of come into play there. What's happening in Ukraine and Russia and so on. So, but at least so far, we haven't seen a kind of a big rise that would tell us that a big rise in electricity prices are coming so far.
Thank you.
You're welcome.
Representative Elberger.
Thank you, Madam Chair. I wonder if you could give us some specific information concerning utility prices, electrical prices in New Hampshire, and particularly as compared to the rest of the region.
That I don't have data for, I'm sorry. I don't have specific data on utility prices for the state as well, but I would think that there are some state-specific factors, but I'd imagine these general price movements happening across the nation, even across the world, are a big part of what would drive state-level data as well. But there might be some specific state-specific factors that I haven't looked at carefully.
Thank you. Thank you, Madam Chair.
There's another representative behind you.
Yes, ma'am.
Behind the screen, too. Representative Popovich.
Thank you, Madam Chairman. Just a quick question, given that a lot of our electricity is produced using natural gas, could you comment on whether a waiver of the provisions of the Jones Act would help drop the pressure on our electricity prices?
Yeah, I think that's a big question. I think a waiver of the Jones Act, in my view, so that's a kind of, there's a political issue there too, but in my view, that'd be a very positive thing for inflation.
No, I'm just interested in the economic perspective, obviously.
Yeah, yes, right. I think purely from an economic perspective, I think it would make it easier to transport things within the nation, and it would, I think, reduce inflationary pressures.
Thank you.
Okay. What about food? So Ukraine, Russia is a major exporter of oil and natural gas. Ukraine is number 5 or 6 in the world in terms of exports of wheat and corn. And so we did see a sharp rise in food commodity prices. I'm showing here the price of corn in blue and the price of wheat in red. So a big increase. In fact, there was a trend preceding even the invasion in early 2022, but there was a sharp rise following the invasion in February of 22. So the levels are high, but again, good news here. I think there was a big drop-off in the price of wheat, as you can see in red there. And the price of corn seems to have stabilized. It did rise, but then more stable. So if I'm kind of trying to project inflation going forward, this is going to say that for some time, if you compare to like a year ago, it's going to reflect that big increase that's happened. But it is now January. It'll soon be February and March, and we're going to get past the period when we saw the big increase in the early part of 22. And at that point, the year-over-year change is not going to be as dramatic. So I would think that as long as the trends continue here, this is going to represent a moderating force on inflation. So again, sort of a positive story. So the general story there is that energy and food prices, by the way, when you construct this inflation metric by looking at household consumption baskets, the crucial thing is how much weight do you put on different components? Like how much do households spend on the various components of this basket that we're talking about? Food is 13%. It changes from time to time. So that's a big bet. We spend a lot of money at grocery stores, buying food for our families. Energy is about 9%. So that's us, filling up our cars, and so together it's a little over 20, and so that's a fifth of the whole basket there. And so what happens to these prices are very important for inflation. And the general story is, yes, they did contribute very substantially to inflation over the past year, but going forward, it seems that as long as the current trends continue, that they will be a moderating force in inflation going forward. So it's a positive story. Moving on. Did anyone have travel plans canceled for over the past 3 years? I had a big international trip planned for April 2020. Of course, we had to cancel that. And then we thought, okay, we're not going to travel internationally, but let's do a national parks trip to Utah and Nevada. And even that, somehow we ended up scheduling during one of the waves or something. So that got canceled. And so we're looking to schedule maybe a bigger trip this year. And I imagine others of you might have done something similar as well. But so big news last year was that there was this thing called revenge travel, where because we're kind of stuck at home, not able to travel for some time, folks were eager to kind of get out and travel domestically and internationally. So that represented huge demand for things like air travel, transportation services, cars, and things like that. And there was a question as to how much of that was driving inflation in those sectors. So here's a chart here. So what's shown in blue is the price of airfares. And what's shown in red is the price of lodging. So the price of staying at hotels and so on. So what do you see here? What you see is that in the middle of 2021, there is that bump that you see, kind of the smaller bump in the middle of 2021. So there was summer of 2021, after being at home for a full year and more, people were wanting to get out, and there was a sort of significant demand for travel. But then in the summer of 22, about 6 months ago, is when this really took off, and airfares were increasing at very dramatic rates and contributed substantially to inflation. So two things happened that really exacerbated this issue. One was people wanted to travel more. There was demand for air travel was high. At the same time, what's the biggest cost of airlines? Fuel prices. And of course, summer of 22 is when gas prices were at their peak, oil prices were at their peak, and this was a tough time to sort of manage fuel costs. And so airlines responded by raising prices a lot. So my family sometimes once every few years travel to the West Coast to see family. And usually all 5 of us go. But last year we saw the airfares, and they were double what we would have expected, even considering that it was summertime. So only 2 of us ended up traveling instead of 5. So we lost a little bit of GDP. Had all 5 of us traveled, we would have contributed more to national output than we did with just 2 of us traveling. So airfares increased dramatically in 22, eye-popping levels. They were like doubling or more. And but what about now? So that happened. What about now? So that's the critical issue here. And if you look at the pattern of the blue line since about June of 22, it's been coming down. Okay, so if you do a year over year on this number, it's going to say that year over year, it's still a very positive high change. It's a very inflationary sector because compared to a year ago, airfares are much, much higher. But at some point this year, we're going to get past that period when that big change happened. And at that point, we're going to be in that downward portion. If the trend continues past June of 22, we're going to eventually the year-over-year calculation will cover that period, and then we're going to see moderation inflation, if not an outright decline in airfares in the price level, and that'd be very positive for inflation. Hotel prices shown in the red line also increased starting in the middle of 21, but not quite as dramatically, and they've stabilized. So we're not seeing these big increases in hotel prices, lodging prices as we did for airfare. So that seems positive. Again, if you do kind of a year-over-year change, it's going to show a little bit of a blip, but not a huge increase.
Excuse me, Representative Almy has a question.
Yes, please.
Thank you. I'm afraid I should have asked this in the previous segment, but in other parts of the world, food is a lot larger part of the budget than it is here. And in other parts of the world, the cost of fuel is a lot higher than it is here.
Yes.
And we're coming through a period when we don't know where we're going to end up. But at what point do you start looking at the market basket again and decide, okay, food is a larger part of the budget, or energy is a larger part of the budget?
Very good question. I think your comments about internationally that basket looking different are spot on. I think our basket reflects kind of the wealth of this nation and what it is that we're able to spend kind of our income on. So we spend far more on travel services and things like that than other countries might. So the basket would look really different if you did an international comparison. But even within the U.S., the basket could and would change just over time, and I think that's part of the updates that the Bureau of Labor Statistics does. I think on a monthly basis that they look at that basket.
Representative Soti has a question.
Yes.
Thank you. Does the in the lodging portion, do you include Airbnb in those type of lodgings?
I had the same question. Does Airbnb get included in this? I don't know the answer to that. It will definitely include traditional lodging places. I would think that Airbnb has been around long enough and important enough that, but I don't know the specific answer there. I should look into it.
Representative Janagian has a question.
Thank you, Madam Chair. Thank you for taking our questions. You had mentioned that energy was about 9% of the basket cost for a household. I'm wondering, do you know what percent energy is of the whole economy?
So that's a good question. When I say 9%, that's about consumer consumption basket, personal consumption expenditures. How much of that goes to gas, electricity? When you ask how much of the U.S. economy is energy, that's a different question. That's like how much of GDP is attributable to the energy producing sector, and so on. I don't have the number off the top of my head there, and I'll have to get back to you on that one.
Okay, thank you.
I see lots of questions. Representative Orrs.
Thank you, Madam Chair, and thank you for taking my question. So we're talking about the weights of the items in the basket. And my financial advisor tells me that the items that affect us most on a day-to-day basis is about 30%. So I'm curious what the other items are in the basket that is weighting these items you're talking about only at 20%. I mean, if I'm doing an audit, I want to look at 80%. So what's the picture of the other 80%?
Okay, so the other big item, which we'll come to, is housing. Housing services is 30%. So most households spend a significant part of their income on their mortgage payments, and if you're not a homeowner, then on rent. So that represents a very significant portion. I mean, we talked about this, and as you're well aware, that's an increasing portion of our budget for many households. So that's about a third. Very important portion of the whole economy as well as inflation. Medical services, a little under 10%. So medical spending, hospital bills, and so on, that's big. And I'm trying to remember some of the other categories here. The next topic is new and used cars, and I believe together they represent about 7%. So that's our payments on cars and the money that we spend. So now we're starting to get closer to 80% when you add that all up.
Representative Fellows has a question.
Thank you, Madam Chair. So I'm looking at the footnotes on some of these charts.
Yes.
And a lot of them, the ones that have to do with CPI, they say U.S. city average. So my question is, is that the U.S. average, or is it U.S. average only of the cities? And the second part of it is, are there any of these measures that New England or New Hampshire or the Northeast has that are significantly different from the whole nation?
On the latter question, I've looked at data specifically for New England region, and almost always the data I see, the region tracks the U.S. very closely. And that's just generally true. I mean, we are a small region, part of the country, so we generally track the rest of the nation fairly closely on things like prices, even with some variations, of course, general patterns about how our labor market does, employment trends, and so on. We track the rest of the nation as well. So I haven't seen sort of big areas, sectors where we deviate from the rest of the nation in a big way. I haven't seen that. On the first question, that's an interesting question. The usual data that the Bureau of Labor Statistics reports is the U.S. city average is what they report as a headline number. Now, you ask an interesting question. This is all based on surveys. And so I think that's a function of kind of how the survey is administered, but how widely that captures sort of what you might consider non-urban areas is a very good question. I don't have I don't know the exact answer to that one. So. Okay, shall we continue here? And I'm glad to entertain questions. I'm glad there's a good engagement here. The other big category is.
I apologize. I missed someone.
No, not a
Representative
problem.
Almy has a question.
Absolutely, yes, please.
So just quickly on urban for the federal government sometimes means as small as a 5,000.
I think that might be
person
right. Yeah,
town.
depending on.
Do you know which one it is for this?
I do not. Sorry. All right. Okay. So the next category is used car prices. So this was also in the news a lot. Shown in red is an index of used car prices, and then shown in blue are new car prices. So what you see here is that throughout 2021, especially in the latter part of 21 and early part of 22, used car prices went up a lot, very dramatically, and contributed a lot to inflation. So used car category, maybe 4% of the consumption basket, but if there's such a dramatic increase in prices, then it can show up in terms of moving the overall price level there. And there was a lot of anecdotes, people getting appraised, their used cars appraised at dealerships or these online places you can go and sell your cars, and getting very surprised by the prices that they were getting. New car prices have also been rising. I found myself in the unfortunate place of needing a new car in April of last year. And the experience of buying a new car at that time was completely different from any other time that I tried to buy a car. And dealerships, basically the initial conversation was, how much of a markup are you willing to pay to buy a car, was kind of the conversation. So that is immediately about inflation. So the new car prices are going up because the effective price that includes all the markups and market adjustments are going to be reflected in inflation. So car prices have been going up. But again, that's been happening. What's the most recent trend? If you take a look at the red line there, if you look at the second half of 2022, starting about June or so, we are seeing, so it has stabilized, and then we're seeing a decline for the most recent 3-4 months or so. A positive sign. So if that trend continues, and signs are that used car prices continue to come down, because there was such a dramatic run-up in prices, it's coming back to more normal levels, they'll be relieving a lot of pressure on inflation. New car prices continue to rise, but if you look at the blue line, the rate of increase is slowing. So it's not falling, but the rate of increase is slowing. Again, a positive thing for inflation. So this is contributing to, currently, it's contributing to year-over-year inflation for sure, but as an outlook, the trend is in the right direction. We might not be seeing quite as big of contributions to inflation from this sector as we have over the past year. Okay, moving on to the next topic here. So everyone's pandemic savings are getting smaller. How will it affect economy is a recent kind of headline from end of last year. So an important observation about U.S. households and when you think about an outlook for the economy going forward, especially when you ask, are we going to have a recession this year or next, and how bad will it be if we do? One important thing to think about is the health of household balance sheets, especially how much cushion American households have in terms of savings that could help in the event that unemployment to rise or there were to be some economic challenges. So to think about this, let's define savings. So this is how savings is defined in official statistics. You take household disposable income, and then you subtract household consumption expenditures, and you subtract other outlays, and then what's left is saved. So kind of makes sense intuitively. So excess savings help households get through difficult economic periods. That's one reason why we care about this. Another factor is that if this is really high, and maybe this gets at one of the representatives' questions earlier, it may fuel high levels of spending. Because when you have a lot of savings, you might spend more of that, and possibly that could contribute to elevated levels of demand in the economy and lead to inflationary pressures. So Federal Reserve estimates that over 2020 and 2021, households accumulated sort of unprecedented levels of excess savings, 2.3 trillion. Why was that? Disposable income was high. So a lot of this was the result of CARES Act, American Rescue Plan Act transfers from federal government to households, which was meant to offset some of the wage income losses and business income losses during that time, but it did more than offset. So the net impact was that households did have to see their savings increase during this period. The other important driver is that our consumption was low. Our expenditures were low. My international trip, which would have cost a good amount, didn't happen. So all that went to savings. And then the extra sofa that I wanted to buy for my home office, I didn't buy one. So that went to savings as well. So things like that led to our savings going up. So that's lower consumption. And then other outlays, lower interest payments from forbearance on student loans, lower interest rates, all of that helped to increase savings during the time. And that led to sort of very, very high levels of what you might call excess savings, comparing actual savings to what you might have expected based on historical trends. So on the next page,
Excuse me, we have a quick question.
Yes, please.
Representative Southworth.
Thank you for taking my question. Of course, these are averages, and I mean, I'm thinking much of the population did not have excess savings, and so that maybe just like we have an upside down pyramid for our business taxes and things, with the top really accounting for most of it. I'm wondering if that same thing may be part of those numbers.
Absolutely, a very, very important point, and absolutely right. We're talking about in the aggregate, when you kind of add up all American households, how things look, that's what this data show here. What is not captured here is the distribution within kind of the aggregate numbers. So the Fed study that I referenced, and there's a link to that study in the bottom of the slide, does get into distributional issues. So very important to note that, not surprisingly, when you look at sort of excess savings, we're talking 2.3 trillion, of very, very large numbers. A large majority of that is held by high income households. That said, when you look at lower income households, so this is based on some studies I've seen recently, and you ask questions like, hey, how much do people have in their checking accounts now for lower income households today versus what they had in 2019 before the pandemic? The checking account balances apparently are higher. So there's some sense in which some of this excess saving, it's not going to be a large majority or anything, but some is held by lower income households, but it is the case that a large majority is held by higher income households. Okay, so chart on the right here is the Fed's estimate of excess savings. So it peaked at about 2.3 trillion, and it's now coming down. Some estimate that this number is coming down by about $100 billion a month. And if I just take that number and let's say that estimate is correct, then it says that by about the end of 23, we'll have exhausted the excess savings, and then we'll have kind of returned to pre-pandemic kind of levels. Yes, sir.
Yes, Representative.
Thank you, Madam Chair. I want to dwell on that for a moment. If excess savings are gone by end of 2023, what does that say about the future economy? Could there be recession? Could there be, instead of inflation, deflation, people, because people aren't buying?
Yeah, so good question. So what would happen if the excess savings that American households currently have are exhausted? So one thing people talk about is that the fact that Americans are sitting on such high levels of excess savings is a good thing and is protecting us against like very severe downside risk in terms of a recession. Because even if there were to be a recession because of the high levels of interest rates and so on, the fact that household balance sheets in the aggregate, there's a distributional issue here, of course, high income, low income, but in the aggregate, the fact that there are a lot of excess savings means that there's purchasing power. There's kind of purchasing power that's out there, and so businesses will still see some demand for their goods and services they provide. So maybe the recession that's coming, if it does come, won't be quite as severe as it might be otherwise. So what Representative Plett was getting at is once this is gone, we don't have that cushion anymore. Will we be exposed to more risk at that time? I think that's generally right. I think it'll bring us back to where we were before the pandemic when we didn't have these excess savings. And so I don't know that that's necessarily kind of a bad place to be, but we won't have the cushion that we currently have that might protect us against a little bit of downside risk.
Representative Leafly.
Thank you. This might be more of a note to ourselves than a question for the speaker, but I'm looking at this chart where it shows our savings going below 5%.
Yes.
And thinking about some of the policies that have pushed these savings up will also be coming to an end at the same time. And so I'm wondering if as a policy, as a committee, it might be really helpful to have someone come who would be able to address federally, what are those policies that are ending, and how does that kind of correspond with these savings coming down? I'm thinking as, a family of modest means, how are they going to be set up to face the oncoming challenges of the economy? Thank you.
I think that's a great idea. And as I'm looking at all these slides, I see that they're dated September in a lot of cases. And we have to open up our crystal ball very soon and make some decisions that are very important to the state.
Yeah.
And would there be any chance you could update this information for us in the very near future?
This is updated as much as is possible, just given, but there's going to be a lag with data. But if it's helpful, I can certainly try and get you the most updated data on any of these data that's of interest to you.
That would be fantastic.
Absolutely.
I see a bunch of hands up. I'll start over here. Representative Fellows.
Thank you, Madam Chair. I just would like a little bit of clarification on some of the definitions that go with this. Is that percentage? Is it a percentage of annual income?
Yes, disposable income. How much of disposable income is going into savings?
And the one on the right, is that the value of all stocks or all?
No, excess savings. So the amount of savings that households have accumulated, a lot of this is in bank accounts, for example.
Okay.
It doesn't have anything to do with stocks or bonds or anything like that. These are how much of the income did we save during the pandemic.
So the one on the right is, if you take what happened on the left, you added up everybody's savings.
Yes.
Okay, nothing to do with stocks. They're just in bank accounts and.
Sorry, I should be careful about the stock issue. What's happening is you're taking the data from the left, which is, and this is a saving rate at a point in time. How much of income you have did you spend, and did you spend on other payments, and how much are you left with? And then what's being done on the right is just tracking that over time, just adding it up over time. So I take back my comment about stocks. People could put that in bank accounts. People could do different things with it. But it's just tracking how much of the big saving increases during the pandemic have accumulated over time. That's what's shown on the right.
Okay.
So what the left is on at a point in time, on the right is cumulative.
And nothing to do with whatever you have invested in stocks.
That's correct. The equity price declines. That's not what this is about here.
Senator Lang has a question.
Thank you, Jason, for taking my question. Thank you for coming. I guess my question, and if you get into this later, that's okay. Just tell me, you'll get an answer later. But is about debt, right? So we saw household debt increase. NerdWallet, I think, reported just today that as of September, 8% roughly, is that household debt increased by over 8% over the previous year. And, a big portion of that was around the housing industry, right? Increasing their debt and housing prices going up and increased debt load. I think our average household debt is around $165,000 now at this point, houses, cars, and everything else. So I guess how does that play? And if there's a slide later, then I kind of flipped through, I didn't see anything on debt, household debt. So I was interested in, we talk about household savings, and we talk about the other side of the conversation, household debt, and how that plays into our future.
I don't have that here, but that's a good question. One thing that's very much related to that is debt service, households' ability to service their debt, and that metric looked really good recently because interest rates were so low. So compared to income, which was healthy overall in recent periods, interest payments on debt were very low just because the interest rate environment was so low, given monetary policy. So they helped a lot. But that's changed. We're in a totally different rate environment now. So debt service requirements are rising. So the portion of income going to debt service, the other outlay category here, is definitely rising as well. So that's an important thing to keep track of. Okay. So I see that yes?
Representative Almy.
Thank you. I actually asked this question 2 years ago of a Fed official, and they told me that only once a year, I think it was in February, they reanalyzed the distribution effect in the savings per household. Is that in this footnote?
It is, yes. So the Fed notes study that I referenced in the slide there, it does have discussion about, it divides the U.S. households into four quartiles: top 25% in terms of income, next 25%, and so on. And then it shows distribution of how much of the excess savings is owned by each of those categories. And as I mentioned earlier, most of this is held by higher income households, but some by lower income as well.
Is there some way that we could get on a picture of those four quartiles for the past 3 years that they've got?
I can certainly say
what I'm looking at is the burden that we're going to have in the social, lost the word at this point, but the social services requirements for the part of our population, the lower half of our population, that may have even less savings than they did in 19 when, as of this last February.
Yeah. I'd certainly be glad to kind of forward that study onto you. I think it's publicly available, and be glad to share that.
Thank you.
Yeah. Okay. So in my remaining 10 minutes here, I'm going to try and see if I can get to kind of the key points remaining here. But I'm glad for all the engagement here. Home prices. So this obviously is a huge topic. It's a huge challenge. Senator Lang just referenced it as well. It's showing up in inflation. Home prices are up year over year, close to 20%. And so, of course, it's going to impact housing prices and the housing components of CPI. As I mentioned earlier, the weight placed on housing in CPI is about 30%. So what happens to housing really matters. Now, there's some good news here. So when this gets a little bit technical, so given the time here, I'm going to try and keep this at a very high level and see if 2/3 of the weight that goes into CPI from housing is for owners of primary residences. So 2/3 by homeowners and 1/3 by renters. Now, so what you need to do is, the economists at the BLS need to track rent payments by renters, as well as they need to do something complicated to figure out something equivalent to rent for homeowners. Because homeowners, we have mortgage payments, but we don't pay any rent. So how do you take what homeowners pay and then turn that into something that looks a little bit like rent? That's a complicated statistical exercise. We don't need to go into that there, but I'll just note that there's a pretty significant lag between the CPI housing metric and what's actually happening in the housing market. And that's because renters, how often do renters sign their leases? How often? Maybe on an annual basis, once a year, maybe even once every 2 years. So when you survey a given renter at a point in time, what you're seeing is not necessarily today's rent. What you might be seeing is rent from a year ago, possibly 2 years ago. And so if newly signed leases are seeing reduced rent, you might miss that if you are basing this housing metric on the total universe of renters, which is what the BLS does. They want the total universe of everybody paying rent, regardless of when they sign their lease. And so there's going to be a lag between what's really happening in the housing market, rent payments, versus this metric that goes into CPI. I don't know if that was confusing at all, but so what you really want to do is you really want to track what's really happening today, because prices of eggs, because we go to the grocery store every week to buy eggs, you're seeing real-time prices pretty much at any point in time, but housing prices, we're updating those prices like every year. So it's really hard to know kind of where you are at a point in time. So when you look at places like Zillow and other vendors that provide more real-time data, rent is coming down. Very positive sign, because that says that when the officials at the Bureau of Labor Statistics update their data, eventually, it might take a little time, maybe up to a year, but it'll reflect that reduced rent that's happening right now. So that I take to be a very positive sign, given the weight on this. If that materializes, I think that'll be a pretty significant moderating force on inflation going forward.
We have some questions for you. Behind
Yes.
you, Representative Popovich.
Obviously, this is a very good explanation of why the lag. I have a question about the regional nature of the data, right? If this analysis in general on the rent pressure is based on national or regional, could you comment on the specific New Hampshire market? Because my perception is that there were certain factors that led to the inflation in housing and rent prices in New Hampshire being higher than regionally. I was wondering what the data shows. I don't want to.
Good question. I've only seen national data on this point. On the point of the lag, I've only seen national data.
Not on the lag, on the general, rise in.
Yeah. Well, if you look at New England data, so the FHFA tracks New England region, and that New England region has seen one of the highest increases in housing prices. So that it will reflect in national data. In terms of rent payments specifically, that I haven't seen broken out for.
Hampshire data isolated out of New England, because obviously we are a small state in a
Yeah.
large region.
Right.
There are certain unique factors that I would like to get information.
Yeah. I don't have that for you in this slide, but that's something that might be available. Yeah.
Follow up.
Okay. Great. Okay. So in the remaining 5 minutes, maybe I'll try to get to the outlook. So I thought what was an excellent, very informative discussion with the labor economists from the state yesterday. So I think I'll skip the labor market discussion, but I'll just note this. So what do you think of the outlook I just gave you on inflation? Like we just spent 45 minutes talking about inflationary outlook. What impression are you walking away with? I think I've given you generally a positive story. That we did see some very sharp rise in prices of different sectors, but things are generally moderating. There are some positive developments that we just discussed. What is the one area that's a concern? And if you ask Chair Powell at the Fed or others, they'll say it's a labor market. The labor market is very, very tight, and they used words like it's extremely out of balance. How many companies are looking for workers? The number of job openings are out there, the recruiting effort that's out there versus the number of unemployed workers looking for work. There are so many more positions open than there are available workers. And that's almost like a structural challenge for the nation. I think the labor economists yesterday did an excellent job kind of going over that for the state in New Hampshire, but as they mentioned, it's a national issue. And so I think that's the concern. Yes, gas prices are coming down. That's great. Food prices are maybe coming down. That's great. Housing prices are coming down. That's great. But if the labor market stays as imbalanced as it is, then there's going to be pressure on wages. And will that lead to companies having to pass on costs to consumers in the form of higher prices? And will that lead to persistent inflation? That's kind of the biggest concern here. So I'll just.
May I ask a question? There's
Of
a
course.
gentleman behind you, Representative Petrie.
Yes.
National GDP versus the ratio of national debt. When should we get concerned?
Okay, ratio of national GDP to national debt. When should we be concerned? Okay, that's a very interesting question. So I think maybe behind that is a concern that there could be risk, perception of risk, maybe of the government being unable to meet all their obligations if a country is issuing too much debt relative to their national output. So there have been studies on this, and I don't know that there's a kind of a clear finding on this. Obviously, there's some level there where the level of debt is just unsustainable, maybe at a very high level. But there are countries out there that have much higher levels of debt to GDP than we do, Japan, and they've been okay. And so I would say it's a little bit unclear where that kind of threshold is there. And I think it's a little bit controversial, even in academic circles, where the United States' current levels of debt to GDP, whether that's too high or too low from a sustainability point of view, I think there are varying views on that point.
Representative Rochford.
Thank you, Madam Chair. Just talking about employment and some of the things that we talked about yesterday, we heard about yesterday, and the workforce, maybe certain segments of the workforce not fully engaging and coming back to participation. So looking at what you were talking about here with the current state of excess savings within the economy and having a burn rate of $100 billion per month, anticipating that kind of coming to an end or normalizing at the end of 23, is it safe to assume that that might inspire or motivate or get some of those people that are not participating back into the workforce?
What an interesting question. That is such an interesting question. I had not heard that, but that resonates with me as a possible outcome there. When people talk about, so yesterday the discussion really focused on like, how do we get workers back, especially sort of they talked about the bookends, the very younger and the older generation that seem to have reduced their participation in the labor force. What can be done about that? The usual answers have to do with early retirement, COVID-related concerns, immigration, maybe a little bit. But I haven't heard this specific issue that maybe the level of excess savings is a cushion that allows some people to stay out of the labor market. But when it does go away, will that bring some of the workers back? I think it's a fascinating question. There may be something to that. I haven't seen studies or analyses of that, but it seems to me just as a directionally, that might be something that that moves in that direction.
Okay, we need to wrap this up soon, so keep that in mind, folks. Representative Almy.
Thank you. One of the things we're dealing with is that the inflation may go down to even 2%, but it will go down with a whole lot of people having a lower increase in their wages than they have in their costs, which then puts more burden either on the town if the state won't do it.
Representative, there a question here, please?
Yes, there's a question there. So the question is, how can we try to understand this relationship between, are we having more economically burdened people in New Hampshire that somehow have to be dealt with? And if most of that savings is in the top 25%, which is what the economist of the Fed 2 years ago said he thought was true, then to what extent is there going to be a motivating influence in the bottom 25% and the bottom half?
Yeah. So multiple things there. If you look at who has seen the highest wage increases, so one very positive development in my mind is that the big wage increases have occurred at the lower end of the income distribution. It's in the leisure and hospitality industry, where the labor shortage is really acute, and they've had to really raise wages. We see a lot of minimum wages going up to $15. So certainly in Massachusetts, that's really helping kind of lower income wages. The other thing I note, so there's a very important question about when inflation does come down, does that also bring down wages, and will that hurt kind of workers, especially kind of the lower income workers? Before the pandemic, inflation was 2 or below, and wages were going up 3% or a little bit more. And I think hopefully what the Fed gets us to is the best case scenario here is without a recession, we have a soft landing where inflation comes back down to around 2%, and then wage growth similar to pre-pandemic, maybe 3% or higher. And I think if we can get there, we'll be in that's kind of the ideal best case scenario that I could imagine.
Senator Rosenwald.
Thank you, Madam Chair. When will we know that? Will it be before the budget is finalized in June?
A very practical question. So timing. So the timing of when inflation will come down, general expectation. So I've provided some outlook here. So the Fed's expectation is that in 2023, inflation will come down a lot, but it'll still going to be higher than 2%. So the expectation is that we'll see about a 3.5% inflation this year, and that it'll come down to 2.5% next year. And 2.5% is pretty close to their target, 2%. And if it's between 2 and 3, I think the only people who are going to care about inflation is going to be economists, people like myself. And I don't think any of you need to really worry about inflation, or other average American is not going to care about inflation at that point. So that's the expectation. Will we go through a big recession to get there? That's the major question. Everybody hopes we won't have to, and I think because there are some positive trends I've shown you in this discussion, I think chances are 50-50 whether we see sort of a recession to get to that lower inflation or not. I think there is a chance, and I certainly hope that materializes, that we don't see a big recession to get there. If there's a recession, it might be a shallow one.
We're running a little out of time. So, because I just want to be respectful to our future speakers, your presentation's been awesome. Thank you. Could you do like a little wrap-up statement?
Yes.
Okay, great. Thank you.
Great. Thank you. So I think the quick wrap-up is what is going to drive Fed policy, where interest rates go, that's going to drive the economy. And what drives Fed's policy this year is going to be inflation. Inflation has so many components to it. I try to hit kind of the key areas. But the sector that the Fed officials are most focused on is the labor market. And as you heard from the state economists yesterday, the labor market is very tight. And hopefully we get to a place where some of the demand comes down, so that maybe the job openings, the recruiting effort by companies comes down a little. But without unemployment going up, without the economy going into a recession that raises unemployment, hopefully we can bring inflation down to kind of where the Fed wants it to be over the rest of this year and next year. And I think there is a chance that might happen, but we might see a recession to get there. But a reasonable guess, that'd be my guess, is that if there's a recession, it'll be a relatively shallow recession.
When?
Possibly second half of this year. Is when economists talk about when that might happen.
Perfect. Thank you so much.
Thank you very much.
Senator Ling, has a sentence to say.
So we were talking about housing prices, rental prices, and Zillow was one of the conversations. So if y'all look at, if you go to an app, Zillow has a rental manager. You can go look at it and it's free. You can take a peek at it and it'll show you if you're given region, what rent prices are doing based on current listings, whether they're up or down. So I just happened to grab Nashua. Nashua's down, but I grabbed Representative Almey's Lebanon. Lebanon's extremely up. So it has some regional rental prices that are real time that you can take a look at if you're trying to understand what's going on in the economy. Overall, when I look at just the whole state of New Hampshire, rental prices month over month are coming down. But still, they're still up over from a year ago, but on average by $75. But month over month, they're slowly starting to come back down. So anyway, it's a good resource if you guys want to look at housing stuff.
Okay, we'll plan to keep moving and we'll try to take a little bit of a break around 11 o'clock before our final speakers. So next up, we have the New Hampshire Business and Industry Association. And with us today, I hope we have Michael Skelton, there he is, as well as Brian Murphy and Steve Dupree. Wonderful. I don't have all of their bios, so forgive me, but Michael Skelton is the president and CEO of BIA, and which is the state's leading business advocate and statewide chamber of commerce. And previous to that, he was the president and CEO of the Greater Manchester Chamber. And the rest of you, I apologize. Please tell us about you when you begin. Thank you.
Thank you. Appreciate the opportunity to be here, and I'll provide a brief introduction to the folks that we've brought along with us today. The BIA, as Representative Sanborn just mentioned, is the statewide Chamber of Commerce, State Manufacturing Association, and we've really enjoyed being invited and participating in this session over the last several years. And I think our approach to this session is a good complement to the excellent presentation you just had, which had a lot of great data and information. What we're going to try and offer today is firsthand perspective and feedback, and what we're hearing directly from business owners and businesses across the Granite State. And to do that, in addition to some comments I'll offer at a very high level, I have the great pleasure of bringing along with us a few BIA members who can speak from their own personal perspective of the economic conditions and challenges that they're facing in their respective businesses. And then we'd be happy to answer questions and offer whatever feedback that we can. Just as an overarching kind of introduction, in our role as a business advocate, as statewide Chamber and Manufacturing Association, we work very hard to connect and listen to our members and the business community across the state, including working with a number of other trade associations and all of our local and regional chambers of commerce across New Hampshire. We conduct a business roundtable process that's very intensive during the summer, where we host roundtables across the entire state, meeting with business owners, trade associations, and local chambers, gathering feedback on challenges and issues and potential solutions that businesses are facing. And that helps us develop our public policy priority document, which we use as really our touchstone guide on all of the issues and policy solutions that we're looking to work with many of you and your colleagues here in the legislature on. This is a pretty comprehensive document that touches on a lot of various issues. I just wanted to highlight three kind of main core topics that we continue to hear from our members on that I think will be useful. And
Mr. Skelton, do you have copies of that document?
I do not have copies with you. I know one was mailed to every member recently, but I will make sure that we deliver extra copies so you have some here. Yeah.
Thank you.
Absolutely. Three main topics that fall within this document that I just wanted to touch on that really have been through lines to our conversations and our roundtables. And I don't think they'll necessarily come as a surprise to any one of you, and certainly with your conversations you've had over the last couple of days. The first is workforce availability. Businesses in all sectors continue to struggle to attract and retain the workforce they need. There's a lot of variables that have played into that. And in many cases, businesses over the last few years have had to change their operations in order to accommodate what workforce they have and what workforce they can bring in. housing availability and affordability is a direct linkage to that workforce availability issue. And I can say in the hundreds of conversations I've had with members across the state, when we start talking about their workforce issues, one of the first items they go to is housing. And they're hearing that directly from their employees or the people they're trying to hire as a barrier to attracting and retaining them. And then finally, cost of energy and energy, the energy market, our energy future here in New Hampshire and New England. As a manufacturing organization, we represent many of our state's manufacturers who are among our most energy price sensitive businesses. And also the stability and reliability of that system is extremely important. And so there's been a lot of volatility, of course, over the last few years in that area. And so that continues to be a major concern. So with that kind of high level introduction, I want to turn it over to my colleagues here that have joined me. And I'm just going to give a brief introduction, then ask them to share a few words about their business and what their experiences have been in the last year and some of their observations for the year ahead. And I think it'll give you a window into what many business owners and business leaders across the state are thinking about. So I'm going to start with Steve Dupree. Steve is a native of North Conway. He actually served in the House in 1973 for for 2 terms, Steve. 2 terms. And he practiced housing and zoning law for 12 years as a partner at Soloway and Hollis, and then he left to get into the real estate development business. He's built over 500 apartments of subsidized housing in the 80s. He owns and operates 300 units still today, and has developed and owns hotels and office buildings in the capital region. So, Steve, turn it over to you.
Thank you. Good morning. I served 50 years ago. I got elected when I was 5. But I knew that it was time for me to go to law school when at one town meeting in Conway, Jess Lyman stood up and figured out my hourly rate at 17 cents an hour and said in a rhetorical question to 2,000 people at town hall, "You're a bit overpaid, don't you think, Mr. Dupree?" So thank you for your service. You're worth every penny and then some. I'll talk to you briefly about a couple things. First, hospitality. Just in terms of trying to plan revenues, you need to remember, even though we've had very robust room and meals tax collection, it's really a tale of 2 states. When COVID came, North Conway, all the tourism, everybody wanted to get out of Dodge, and room and meals taxes collections there are tremendous. But in the business travel market, which is primarily Concord, Manchester, Nashua, Salem, to some degree Keene, and to some degree Portsmouth, although the presence of the shipyard really distorts that market, it has not come back to pre-2019 levels, and frankly isn't expected to get to 2019 levels until 2024, assuming there's no recession. I base that on the fact that I subscribe to a lot of econometric models, and Marriott and Hilton, I'm a franchisee of both, provide us data. What's happened with business travel? I can give you a classic case. The fellow who organizes or has the contract to organize the signs on the interstate, you know, this Hilton Hotel, this exit, is from Mississippi. He used to come once a month pre-COVID to meet with his representatives at DOT to make sure everything was going smoothly, sell a few more signs. Now, in COVID, he didn't come at all. Now he comes 7 times a year because he doesn't have to leave Jackson, Mississippi on a full day to get up here, a day of 2 of work, and then a day back. So he does 6 or 7, and he does the rest by Zoom. So business travel is forever changed in New Hampshire. So when you're estimating revenues, and I'm sure Revenue Administration can help you with that, you need to look very careful at, I would not anticipate any increase in your business travel market room and meals over what you see this year. And maybe if there's a recession, a slight decrease. I do think, however, that the rates that you're seeing, which got much higher in the tourism market, it's a yield management business like airlines, are going to have just as good or better year. I like to remind my colleagues around the country when I go to a conference that I'd much rather own a Marriott Courtyard or a Residence Inn in North Conway than in the middle of Kansas somewhere, because so many people can get to us, and when there are recessions, we see fewer people fly and more people drive to their vacation. Our challenges are workers like everybody had. We applied for the lottery and the H-1B visa. When we closed the Courtyard by Marriott for 15 months. We closed the Fairfield for 8 months down at exit 12 where we have the Hilton True. We had that done in January. We didn't open it till September because of the COVID restrictions. But when we did, we didn't have enough workers and we couldn't open rooms. We'd make sure all our rooms were ready for the weekends because that's still our busiest travel time. We get tourists coming through. That's why we don't want 93 expanded. We want them all to stop and have to stay in Concord overnight. And literally, we couldn't open rooms Monday, Tuesday, Wednesday. We didn't have enough housekeepers. The H-1B visa helped us a great deal. The other energy costs are out there, housing, I'll talk about that in a little bit. But the other issue we're having in the core cities and business travel is security. Security from the homeless. And I will give you a case in point. This morning, before I came over here, I got a call from the county attorney that a gentleman who has severe psychiatric and drug issues is being released from the county jail. He was declared incompetent to stand trial. They gave him medication at the hospital. They released him. He has 3 times come to the Residence Inn because he thinks that's the center of the oligarchy that's running the world and taken an axe to our building. We have no do not trespass orders, so we now pay $250,000 a year for security personnel at all our hotels, headed up by a just retired sergeant at the state prison. That's happening in Manchester, it's happening in Nashua, it's happening in Salem. Security is a big issue, and what that does is that lowers our profit, which then reflects, we certainly will reflect that in the numbers we give to the city when they assess our property. Not a direct cost, but it's a tangential cost in the business markets. And then just switching to real estate development, I will leave with you a little case study. I'm a pretty simple guy, so I started doing Section 8 housing when it first started, sort of like being in a house 50 years ago, and built a lot of units. I still have units in West Stewartstown, Lebanon, Hooksett, Meredith, North Conway, Wakefield, some other place. And the affordability issue, there are no easy solutions. Mark Twain used to say, everyone likes to complain about the weather, but nobody does anything about it. And unfortunately, that's sort of the housing issue. But I will leave with you, and I won't go into great detail, but I will leave with you an example of what the cost of one unit does and what it results in rent. And the bottom line is right now, construction costs are ranging between $300 a square foot and $800 a square foot. $800 a square foot. And that combined with the mortgage rates has slowed down residential construction. When I talk to the architects, engineers, and I start with surveyors because they get the first call on development, they're still busy. They're doing a lot of permitting, but a lot of people are holding back. And a friend of mine, Dick Anagnos, very successful apartment developer, just put on hold a 200-unit complex in Lebanon, New Hampshire, which has some of the highest rents because he can't make the numbers work given construction costs. The bad news is for you folks who have to solve the housing problem, there is no significant diminishment of prices for commodities, building materials, or subcontracting. The subcontracting, by virtue of the fact we don't have enough people in those fields, but the materials have not come down. And if you look historically, I hate to date myself, but if you look historically at the 75 to 79 recession, the bank failures up here, 87 to 89, the 2001 recession, the 2008 recession, prices were going up before. They came down a little bit in construction, but they never go back to the pre-boost. So $300, if you can build a housing unit, an apartment unit for $300 a foot all in, you're doing exceptionally well. And I don't know any developer who can, but I'll pass these around. But it gives an example that to build an 850 square foot apartment, you need to collect rents of $2,482 a month or $29,784 a year. And if you have people who make an $80,000 combined family income at 30%, they could afford to pay $24,000. That's why the only place, there are a lot of projects being approved in the Seacoast. That's sort of a anomaly because that's driven by the very, very high median wage created primarily by the shipyard. So there are no easy answers. Density is one of the key ones. The borderland and tax appeal help a lot. I hope you'll keep that in place. But density alone won't solve the problem. And short of deep subsidies, smaller units, quicker ways to permit construction, you're really going to be working at the edges on housing. I will just add this one last footnote. One of the things that was added last year was Fishing Game, which is a wonderful organization. I'm a sportsman. Reviews development plans now. That has slowed down project processing dramatically. And I know they're trying to compensate for it by assigning folks over from environmental services, but it is a long delay and it adds a delay. I'm not commenting on whether it's worthwhile, but we got a way to speed that up.
Senator Lang.
Thank you, Mr. Dupree, for presenting. I guess I'm looking for, you just gave the $300, $800 square foot cost. What was it before? I don't have a reference point on that, so I'd love to.
It was about $140, $150 going into 2019. For those of you who visited or seen the True Hotel, I built that in 2019, right before COVID, for $135,000 a room. I just had, for the exercise that I knew was coming up, had it quoted again today. It's $205,000. And I go, wait a minute, the market's not that good. And, you know, wages have gone up, so rates have gone up. We hire a lot of the new Americans. You don't have to speak English. You don't have to have a high school education. They're some of the best workers we have. Our part-time people get $15 an hour. Our full-time people, we don't have anybody under $18 an hour, and we give full benefits. So you can see why that, with energy costs, why your hotel rooms cost a little bit more. And back in the days when I used to offer them to legislators at the Comfort Inn for $10 a night, we can't do it anymore.
Mr. Dupree, there's a question behind you, Representative Popovich.
Just a quick question. Obviously, we are all familiar with the cost inputs into your business model. Could you comment a bit more about the indirect input of, you know, zoning and planning, and what does that do to the ability to just provide affordable housing in the state?
There's no question. The leader in this effort about 20 years ago, I remember the home builders, was Humphreys Architects out of Dallas. I remember going to home builders and they said, we can do 60 to 70 units an acre. I go, what? How could that be? But in mixed use development, you can achieve those kind of densities. By comparison, when I tried to build a 24 unit USDA 515 family housing project in Hopkinton 20 years ago, they changed the zoning and made it 4 acres per unit. So I needed 100 acres. I mean, so the land cost, your land cost and infrastructure shouldn't exceed more than 10 to 15% of your total project costs. So when you double and triple density, you're helping, you know, let's go 20%. Let's say now it's 20%. You're helping on the margins. That alone isn't enough. What's happened in most industrialized countries, not that I like to hold up China as a good example of anything, but they build buildings much quicker to the same energy code or higher with better earthquake code than we do, because they compartmentalize everything. So for example, in China, they build a wall and they put the plumbing and the electric in it. It's finished on the inside. They put it together and you snap it together like a Lego set. Our codes don't allow that. That's nothing to do with New Hampshire. That's the National Fire Code, the National Electrical Code, where the inspector has to come look at it before the wall's covered up. We are way behind Europe. We're way behind Asia in how you build. I would love to see New Hampshire become on the forefront of trying this. There are ways to do it, and we need to do it. If you combine all those things together, then you can impact it. But zoning is a very key part of it.
Thank you. I appreciate it.
Senator Murphy.
Thank you, Madam Chair. Thanks for this. This is an excellent example and very simple to follow. We have a lot of overlap in our businesses, and what I'm seeing is that, anecdotally, is that the pre-pandemic employee is not the same as the post-pandemic employee. 30 hours is the new full-time, and that's one of the reasons why the labor market's so squished. And I wonder, are you seeing the same thing, and are you seeing it getting any better as we go forward?
Yes and yes. The biggest exodus was from direct service business. You know, you can do, I have a son who works for a company, and he can work from anywhere. It's pretty hard to check people into a hotel room or serve a meal or wash a dish. So we saw a lot of people bail out and find other work. That said, I will tell you, and we're also in property management. We manage about 3 million square feet office space and 4,000 apartments and condominiums. What we're finding is that in the last 3 months, we're at least getting resumes of good qualified people. A year ago, we'd post a job for a maintenance technician at $25 an hour. Maintenance technician, you don't have to know how to do anything. You're not an electrician, not a plumber, you're not a carpenter, you're just a maintenance guy. and we would get no response at $25 an hour. Now we're getting some decent candidates. So I think it is loosening up a little bit. I think people have spent through what they saved. You heard the Federal Home Loan Bank show that savings from all the COVID relief, that's been spent down and people are back in the market. But I think long-term, people have bailed out of hospitality, and the only way we're going to be competitive is we're going to have to overpay to get people to stay in that industry.
Thank you very much.
Great. Next, I'd like to introduce Brian Murphy. He's the co-owner of Boyce Highlands here in Concord and Highland Hardwoods in Brentwood. He's been in the forest products and architectural millwork industry for 40 years. Started at Boyce in 2003 and purchased the company 10 years ago, and just recently purchased Highland Hardwoods in October of 2021. Has a combined 91 employees, and Brian also serves as co-chair of the BIA's Economic Development Committee. Brian.
Thank you, everyone, for allowing me to present here today. I think anytime government can get with private business, only good things can happen with sharing ideas. Not to beat a dead horse, you've heard it from many, many people. Workforce housing is a key issue, a very big issue. One I'd like to at least bring to light today is attracting people to the trades. There has been and continues to be a stigma in this country, including this state, of guidance counselors asking students that if they're going to be successful, they need a 4-year degree, they need to go to college. And I'm a member of the National Board of Skills USA, which is trade schools starting in high school. And these young people get involved in the trades. And with a 2-year post-secondary education degree, these students can be making anywhere between $60,000 and $90,000 a year, being an electrician, a plumber, and working in our industry, the woodworking industry. And I think that we're doing a disservice putting that stigma on not having a 4-year college education. There's a tremendous workforce out there that they're going to college and they're coming out with $100,000 to $200,000 in debt and European or ancient Chinese studies. Where are they going to get a job that is going to contribute to the economy? So Florida has a very good program, and I would just like to start the process. New Hampshire, combined with the state and private businesses, make investments in trade schools and supporting students with incentives to have their education partially or completely subsidized if they remain in this great state and begin their careers here in New Hampshire. The governor talks about people getting their education and then leaving the state. This would be a great incentive to stay here. There are a tremendous amount of job opportunities in the trades nationally and also here in New Hampshire. We are down 14 employees since COVID. And what has forced us to do is we've been into forced automation now. We're our 3rd year of a 5-year project with that. And at the end of that, we're going to have the opportunity for less employees. And machinery is great, but when you have a trained workforce who cares about what they do, it's very important to producing a good product. The skills are aging out and need to be replenished in New Hampshire and across the country. The repercussions from this, we're experiencing burnout from employees working 50, 60, 70 hours a week. It not only puts them in danger, it puts their mental attitude in danger, and it puts a crimp upon their home life, being it's very important to be home with their families. These people are very dedicated, very hard to work. They show up early, they stay late, and they would like to have some people working next to them that they could train so that they could all work together. If we ask our customers for longer lead times, our industry is 2 weeks or sooner. We're the last trade on the job, so to speak. At Boyce Highlands, we manufacture the finest architectural moldings in the industry right here in Concord, New Hampshire. Our moldings are in the White House, they're in the Senate, they're in Harvard and Yale, and everywhere across the United States. where all the moldings downstairs and across the street are. And the carpet and the millwork. So we're the last trade. Everyone else has 9 or 10 months to get their job done. They're all late. So we come in and we have to perform. So if you go out to 8, 10, 12 weeks, then those jobs can be taken offshore. They can be done overseas and they come back in. So we are all about getting it done perfectly with a highly trained workforce and meeting or exceeding our customers' expectations. So revenues are down because of wage inflation and turnover costs. That's another aspect of this. And then the biggest part, I'd just like to say, I'm originally from Finger Lakes region of central New York. I'm proud to be a New Hampshire resident. I think it's a great state. I love the state. I love the fact that one voice counts, which today is an opportunity to represent that. I think we have a very good business atmosphere. I'd like to be part of making it better. Does anyone have any questions?
Representative Fellows.
Thank you. You're suggesting that there should be more trade schools. I'm wondering where are the ones that you're referring to, because I live in Grafton County, and I don't know of trade schools that are up in there, that area. And the second question I have has to do about your workforce. Do you train them on the job, or what skills do they, if not, what skills do they need?
That's a great question. They need to show up on time and they need to have a great attitude. That's the beginning, and we will teach them all the rest. We have very nice German equipment that we have molders, we have sanders, we have finish equipment, and we have so many areas. Steve mentioned maintenance people. Our maintenance people are the highest paid people in our organization. And they are people who have all the skills of the plumbers, the electricians and whatnot. And they keep us running. So as far as schools, Pennsylvania has many trade schools, and they have specific woodworking trades. They have plumbing trades. And these students coming out of Skills USA, which is a national organization of students who work in everything from outboard motors to millwork to sewing, everything in the world. And when you see these students go to a national competition and compete, and you see their eyes light up with what the possibilities are, because people from industry are there to hire them and put them into trade schools right out of there. So we recently had UNH come and talk to us, and they talked about helping the co-investment. And what one of my statements is, the trades are much more useful to manufacturing here in New Hampshire than 18th century studies of Europe. So give us students who have skills that we can put into manufacturing in this state. And it could be a great career. It could be as little as a 2-year program. With that comes a lot of infrastructure. And I know that being involved in an organization called Architectural Woodworking Institute, AWI, they're a national organization of accreditation of quality of millwork standards. And you have a whole nation of business owners who are willing to work and step up to the plate to help educate these students in these trades. So it's a great opportunity.
Thank you, Mr. Murphy. There's a question behind you. Representative Popovich has a question.
Thank you for taking the question. Just as a follow-up to the question we had, if somebody comes in with a great attitude and comes in on time, what would be the starting wage they can expect, and what can they get once they are fully trained?
That's a great question. 3 years ago, our starting wage was at $14 an hour for an entry level position. Our lowest wage right now is $18 an hour. And we have our skilled operators are making upwards of $30 an hour.
There's a number of questions. I have Representative Leapley next.
Thank you. We don't have all of the presenters' names on our presentation sheet. I'm wondering if, I think it's Dave, and Brian.
Yes.
Can give us your last names and
Sure.
spell them?
Go ahead.
You go ahead.
Steve Duprey. Duprey.
Thank you.
My great grandfather snuck across the border. He changed it.
And
I'll,
Brian?
I'll spell it's Brien Murphy, Murphy.
Thank you. And just a comment that my doctorate in medieval studies actually makes it so I appreciate fine architecture and the trades because, of course, they were using
Well
those back
spoken.
then.
Thank you.
Senator Rosenwald has a question.
Thank you. And let me also offer my art history degree as
If you
someone
heard me
who
properly, I said they wouldn't be
architecture.
applicable in my industry.
But I would appreciate the architectural moldings. I have
Thank
two
you.
questions, if I could. Anecdotally, we've heard that along with the wage and burnout problems in both hospitality and construction, there's the problem of alcohol and substance use disorders. And I'm wondering how you feel that's impacting your industries, if not your particular companies.
Our particular businesses, both at Boys Highlands and Highland Hardwoods, we've been very fortunate in that we haven't experienced those. We have and continue to develop a family atmosphere at our work. So it's very open that the person on the floor can come up, their manager or anyone above if they have issues. We're very involved in housing. If we have an employee who has a critical housing situation and they need a loan to get into something else, we take care of them. We realize we want to have people for life. And in these days, that's not something that's usual. People come and they go, but we're trying to create a skill level and have them feel that they're part of something bigger, and that we currently are not experiencing anything that I'm aware of in those issues.
No, but in your industry at large, do you hear of?
I would say no, because our industry is very, very technically focused with very expensive woodworking equipment, which you can get hurt or killed very easily. I mean, there's great safety involved in everything that we do. So if all of our managers are very highly trained to detect any type of impairment when the employees come in the morning. And since I've been here since 2003, we've had one incident in that amount of time where someone came in impaired.
Great. And Mr. Dupree, your industry?
We do a bunch of things. We have mandatory drug testing before you become an employee. I will say that we have about 300 employees, full and part-time, and a fair percentage of those are new Americans. Concord's a resettlement community, and I'll be very honest, they're some of our best employees, and they tend to have fewer of those issues because, frankly, they're just grateful to be in this country legally and have a job. What we found, though, and it started in COVID, childcare, we have a lot of single parents who work for us, like everyone in New Hampshire, and the compounding of having to try and do a job and also be educating your child at home, or childcare, lack of childcare, was a huge challenge. So what we found overall is that our HR department has had to beef up, and we're much more of a wraparound service. So we count on all our managers. Our groupings are very small. Like, for example, at the courtyard, I think we have 8 housekeepers, and there's a housekeeping supervisor. That housekeeping supervisor is responsible not only for making sure the job's done, but making sure they understand what's going on with that associate. Is that associate having a problem with a sick child at home that's got to continue? So what it's required, I think every business has had to spend more effort, and in our case, it's obviously more money, and I think true for any size business, on HR functions. HR has become much more of a taking care of your employee holistically rather than just making sure you're following the wage laws and the I-9s and stuff like that. And I don't see that changing. Frankly, the younger employees who come to us now expect that. They expect HR to help them with everything. And that's cool. That's fine. If that's what we have to do for employees, it makes for a better balanced employee. We generally, because we're not like a fast food restaurant that has that really high charge, we have the Grapponi Conference Center. When we're plating 400 dinners, there's a hustle, but it's not like as difficult as it is, as stressful perhaps, although my kitchen crew would argue and shoot me for saying that, as some restaurants. So we've been able to have it. Have we had some people who have come to work impaired? Yes. We tend to, have we referred some people out a few people over the last 5 years who've needed really a strong intervention? Yes. But if you create a good workplace culture and people want to work there, you tend to attract people who hear about you, who know that we're looking out for you. But it takes a lot more effort for every business.
Thank you. If I could ask a more general question.
Or follow up.
Yesterday, we heard that women with younger age children are disproportionately staying out of the workforce, and that the social assistance category of labor is among our highest job loss. And I'm just wondering, among your members of the BIA, how serious a concern is lack of access to available and affordable childcare, in addition to the wage issue and housing that you've brought up?
Yeah, thank you for the question, Senator. When I mentioned earlier that when I meet with our members across the state or with business owners, usually the conversation starts around workforce availability and workforce challenges, and then it goes in one or two directions as one of the potential root causes of some of the challenges they're facing. Housing is usually there. Childcare is the next one, and it's right there alongside of it increasingly. And it has become a topic of much more frequent conversation in terms of, as part of our workforce development strategies, an area where we need to be thinking what partnerships can we have with other organizations, and how can we work with the legislature on solutions that will strengthen the childcare industry, that will see more capacity in the childcare industry. I can speak to this myself. I have two children. My youngest is in daycare, and recently the daycare that we were very fortunate to have a spot in and have our children go through let us know that for all the families that are in our daycare, if you're planning on having another child, to let them know soon, because the waiting time for a new spot was 16 months. And that is, for families to have to manage that, and to then, to your point about ensuring that they can be available in the workforce, I think that is a huge part of the labor participation rate changes we've seen over the past few years. And there's both a cost issue and a capacity issue in the childcare industry. And I know that's a whole other topic we could dig into, but there's lots of different entities that are looking at how can we strengthen that industry. And I think if we're able to make some positive gains in strengthening that industry, our workforce will most certainly benefit.
Representative Ames.
Thank you, and thanks for the excellent insights into what's happening in your worlds and our world. This paper, Mr. Dupre, it's very useful and helpful. Down 2/3 of the way, you talk about high property tax towns, and it looks like there's a premium on the resulting rent that would result in those towns of about $165 a month, I think. What do you mean by high property? How do you measure that? And maybe you could go into the property tax impact more broadly.
Concord, in Concord, we have a lot of tax exempt property. And the resulting costs, our tax burden, although Concord does a great job managing their tax burden compared to surrounding towns, and we also have an independent school district which sets its own budget independent of the Concord City Council. So those just it's a bill handed to the city and added. So that's a high tax burden town. Moulton Borough is a low tax burden town because they're fortunate to have a lot of lakefront property at a very high value. I mean, the rule of thumb generally in apartment nationally, if you looked at it, you usually assume your base cost of production, it's another 50%. That can be everything from utilities that you pay for common areas. Some apartments, they actually pay the utilities. It can be snow up here and Florida, it's probably greater land care, but that 40% is actually pretty lean. I think most apartment developers in New Hampshire will tell you that they run at a 50% burden over the base cost of the housing for maintenance, property management, leasing, all those things. And the $300 a foot is, to be very honest, low. For new house construction, I checked with 3 builders in this market, in the Concord market, because I was preparing for this. They're quoting starter homes, what we would call a good basic starter home, at $500 to $600 a foot. And I can tell you, just commercial construction. I just got approved for a 25,000 square foot 5-story building that when I looked at it pre-COVID, I had a price quote of $250 a foot, and we've been working really hard to get it down to $480 a foot now. And that's, there's still stuff in the pipeline. The surveyors are busy, the engineers are busy, but they have noticed that in addition to residential construction dropping off, interest rates and costs being those 2 factors, that in the commercial construction, it's municipal and governmental and institutional work that's still very busy, but they're seeing that start to thin out a little bit as all the relief money and towns have spent that upgrading their schools or their police stations. And that you're seeing a lot of commercial construction like I do for office buildings getting priced, but we're putting it on hold because it's just impossible to make the numbers work compared to where they were 4 years ago. So I think even if we don't have a recession, just for your planning purposes, you're going to see a slowdown start to hit. Obviously, it's already starting to hit in the housing market because of the interest rates, but you're going to start to see a fairly substantial slowdown in commercial construction just because people cannot make projects work.
Representative Southworth and Representative Elberger.
Thank you, and thank you for taking my question. I want to ask Brian a question. It sounds like a great business. I was trying to picture, maybe you can describe it, the starting person at $14 an hour. Are they perhaps either living at home or maybe even still under their parents' health insurance? I'm just trying to see with all of our housing
That's
numbers.
a great question that puts everything in perspective.
Yeah.
The answer is yes.
Yeah.
They're generally a young person who's living at home or have roommates. We have had some pretty good success with people living together in recovery homes. And one person comes to work and they show up at work and they say, hey, this is a pretty nice place to work. And then a year later, we have 4 of those folks working with us. So yes, a lot of our employees are living at home, or they're dual income families who are, the father works the night shift and the mother works the day shift. We run from 5 in the morning until midnight, so they have the availability to work either shift so that they can work around childcare and things of that nature. So yeah, when you get to $18 an hour, that is a function of not having people go and flip burgers. As I say, that's a starting wage.
Yeah.
At Boys Highlands. It's even more difficult at Highland Hardwoods because they're closer to the seacoast in Brentwood, with your cost of living over there even higher.
Yeah.
So we have a great workforce. Right now we're in the hiring a top line manager who's going to move from the Catskill region of New York State. And we're very concerned about finding a place for him and his family to move to in that area and have it affordable.
Yeah. Thank you. That's very helpful. I think, like this chart, that having an idea of what the $14 an hour person and $18 person looks like is very helpful.
Yeah, and they also see the opportunity. We do a lot of cross training and we give credits, and you get an increase in pay every time you cross train for a different department, whether it be the finish department, the rough mill, the sanding department, the molder department. So they can see a ladder to getting an increase in pay and a better standard of living for themselves.
That's useful information. Thank you.
Thank you, Madam Chair. Steve, I was struck by one of the things that you just said about commercial building seeming to slow down. And I wonder, given the fact that so many businesses were switching to work from home and some of those folks are staying home, whether you're seeing that the need for commercial office space is going to stay low and how that would affect your job, your business.
Yeah, it's great in COVID to be in hospitality and office space. I know to pick great horses, huh? In business travel hospitality. We were fortunate. Concord's a little bit of an aberration. Where state and federal governments are, offices tend to be. It's very hard for the BIA to be a great government relations function and interface with you by Zoom all the time. You all lived through that during COVID. So Concord's a little bit of an outlier that law firms anybody who does business with the government's probably going to still need an office. When COVID started, a lot of our tenants, and we're the landlord to a lot of the law firms in town, said, oh, we want to give back space. But then when they thought about it, they said, we have more people coming and going, but we're probably going to keep the same space and reconfigure it. But in terms of new demand, absent a Chubb or Lincoln Financial moving back into town, you're just not seeing those big users. Although, again, aberrations, the two markets that really stand out, the Upper Valley, Dartmouth has started to really capitalize on the brain power there, engineering school, medical school, and there's a lot of startup businesses that take off and then grow employees. And of course, I'm the chairman of the Pease Development Authority, and I can tell you we're filled to the gills over there and trying to find a way to fit more business in. Sig Sauer's expansion, Lonza's expansion, very high paid jobs. But so office space, I think over the long term in downtown cities is changing. Shane Brady and Arthur Sullivan, who own a lot of buildings in Manchester, are converting empty floors. 1000 Elm Street, for those who remember that first, they're converting empty floors into apartments. And just a footnote on that, because I love studying this. 5 years ago, we were 5,000 housing units short. Today, we're theoretically 22,000 housing units short, but we haven't seen that much of an increase in household formation. What gives? I'm not saying this because I'm in the hotel business and I have any axe to grind with third-party rentals like Airbnb. I've used them, but I think what's happened in Mount Washington Valley is you're much better off to rent your condo for one weekend a month at a nice high rent rather than letting a tenant take it for a year. And that, again, I'm not saying it's bad. It's created a lot of wealth for people who engage in that, and it's been great to help a lot of people. But that has taken a huge number of available rental units, in my opinion, out of the market.
We're a little short on time, but we have a bunch of hands up. So we're going to start with Representative Plett and then go to Representative Orrs.
Yeah, Mr. Dupree, you caught my attention. I'm going to ask again, $500 a foot for construction, does that apply to all kinds of construction, housing or commercial? What?
That's housing right now.
Well, it's $500 a foot. If those numbers are fantastic because you have a 1,600 modest home, modest home, that's $800,000.
Literally, that's why the trading market in commercial properties, people are bidding up prices. Like right now, the hotel business isn't great, but we're seeing, and interest rates are high, but we get unsolicited offers all the time at record high rates because they figured out you can't replicate it for what you can own it. And commercial construction, I looked at the numbers for the Merrimack County Courthouse that we did, 7 years ago? And we were $300 a foot. That would be $1,000 a foot now for an institutional quality building.
Can't stay there.
I know. And, it will come down somewhat. That's why if you look at the home builders looks at every recession we've had, it brings stuff down some level, but it never goes back. And I'll give you this example. I tracked 2x4 prices. In February of 2020, before COVID, a 10-foot 2x4 was $3. When COVID hit in the summer of 20, it went to $11. In the summer of 21, it dropped down to $4.50, and everybody thought we were getting a bargain. It was a 50% increase, but we wanted all you could get. And then in the fall of 21, it bounced up to $10, and I haven't dared look since then. But it's never going back to $3. Is it going to be $4.50 or $5? But even if it's $4.50, that's a 50% increase in your framing. Most builders now who are doing home building, and even commercial construction, like I'm fitting up a building for the Department of Justice, they'll only give you a quote 20 to 30 days in advance of when they start because they can't take small builders particularly can't take that pricing risk.
Thank you, Madam Chair, and thank you for taking my question. So earlier you mentioned you screen individuals for drugs and that kind of thing. So how's that impacting your business? And what is the percentage that pass? I have a friend that hires in Pennsylvania, and he was telling me it takes 20 people to hire two. So he's got about a 90% rejection rate. And I'm just curious if that's still true or what you're experiencing here in New Hampshire. Hopefully it's a lot
Take
less.
that one first, or? I mean, we're not nearly that high because we tell people when they apply for a job, they have to take a drug test. So a lot of people self-screen out. And, you know, to be honest, we used to have a policy that if you had any felony conviction at any time in your life, you were not eligible for employment with us. But we've looked at some, I'll say we've made exceptions where somebody was convicted of marijuana possession at a felony level 17 years ago and they've never had another offense. Great, we'll give that person a shot. But it's not nearly that high. Again, we're probably biased because people self-select and go, I'm not going to apply. But the other thing that's amazing, though, there are people who do apply and take the drug test and fail the drug test knowing you're going to take one. I'm going, they didn't, we did not hire them because of the drug test. We hired them because of the intelligence test.
Representative Almy has a question, and then we'll look for like a closing statement from you, Michael. Thank you.
Thanks. Staying with the workforce again, we have had a problem in a number of our schools, including in Lebanon, that the school is oriented entirely towards college, as you started out saying at the beginning. And what happens is that a lot of kids who feel like they don't want to do college and that kind of career, they drop out mentally very early in the school process and they start doing drugs. We had one of the first heroin crises in New Hampshire, I think, in our area.
Does the member have a question, please?
The question is this, are you having any more success than you've had in the past with breaking through to school boards and school superintendents with respect to their understanding that there are productive careers for people that are not going through college?
That's a very good question. I've recently become involved with the MEP, which I find is a great organization in this state, and getting involved with 8th and 9th graders, getting them involved early. 7th, 8th, and 9th graders, it's almost too late when they're seniors because they do tend to drop out. And we are going to take part in a program that they have every year of bringing the students to manufacturing facilities throughout the state. I personally am very open to anyone that I could get in front of to talk about the opportunities in the trades. The guidance counselors are doing what they were taught to do, but there are thousands of students being left behind. And these students, you take a farm kid who's got a good work ethic, and they have more skills than a lot of people coming in the door. And those are the type of people we'd like to take and train and work with. But getting trade organizations to do that would be a fantastic way to grow throughout the state.
I'll just add one quick addendum to that. And this may be something that the legislature can think about and help with. I think our challenge with business partnership with our public schools is how to scale it. We have lots of school districts in New Hampshire, and they all work independently. There has to be more ways that when we're looking for business partnerships, we can do it at scale with many of them at once, rather than individually having to work with each individual school, each individual district, going to each school board. That becomes simply too much for our business organizations and businesses who don't have the time and resources to be able to do that. There's a willingness to partner, but we have to find a way to scale it up at a higher level.
Thank you.
A lot of great information here. We're going to have to wrap it up, I think. Thank you. If you have any information that you'd like to submit to us, it would be great because we've been taking copious notes. But if you have more that you want to share with us, we would probably really appreciate that as we look for our revenue estimates. Thank you very much.
If I could just add one closing comment to, um, it's always a treat for me when I'm able to bring members to settings like this because you can see the wealth of knowledge they bring. And I would just leave this as an open invitation that at any time during the legislative session, if the BIA can be a resource in bringing members from various industry sectors to come and give you a firsthand account of what they're working on and what they're dealing with, we'd be happy to do that. They are the subject matter experts, and I think are incredible resources for you as you do your work. So thank you for the opportunity today.
Thank you so much. And members, why don't you take a 5-minute little stretch break, and then we'll come right back.
Thank you for your
Thank you.
service. You're worth every minute.
Good morning. We'll get started again. This segment is the real estate market, and we are very lucky to have three people here today. Ben Cushing is the 2023 president of the New Hampshire Association of Realtors, and he has previously served as the organization's treasurer. Ben has been practicing real estate for 25 years and is currently vice president and regional manager of Four Seasons Sotheby International Realty in the Upper Valley. Welcome. We also have Chris Norwood here, serving his 5th year as chair of the New Hampshire Association of Realtors. Now, is that commercial realtors or all realtors?
That is the Public Policy Committee chair.
Excellent. I apologize. Public Policy Committee. Gotcha. He is also chair of the New Hampshire Housing and Finance Authority Board and past president of the New Hampshire Commercial Investment Advisor Board of Realtors. A 21-year realtor, Chris is president of NII Norwood Group, a commercial real estate firm in Bedford. And Bob Quinn is chief executive officer of the New Hampshire Association of Realtors, where he previously served as the organization's government affairs director. Welcome to Ways and Means.
Thank you.
Joint Ways and Means. Go ahead.
Thank you very much for having us, and good morning. My name is Ben Cushing, and I reside in New London and do work in the Upper Valley. I'm licensed as a realtor both in New Hampshire and in Vermont, and basically practice real estate in the Lake Sunapee region of New Hampshire. You know, as a realtor, we've had a pretty good ride in the last couple of years. Sales have been rather brisk, and we have done very well. We've had records, not only for my company, but we've had record sales in the state of New Hampshire. However, there's a little bit of a different feel in the air right now, that things might be changing. And I'm sure that's part of the reason why we might be here chatting with everybody today, that some of us feel that same way. I know in my company we're feeling that. We're looking at different things that might be happening, even though we've started the year off with some really big sales, high dollar sales in the Upper Valley region, at least, that have been happening. So, you know, what has gone on in the last few years has been very interesting in that, you know, my 25, 26 years in real estate, you know, the average days on market when I was a 10-year veteran in the New London area was about 150 days. The average days on market for a home, we thought that was really good. If a house is on the market for more than 15 minutes today, we joke that there's a problem. And as you see on the sheet that Bob, I believe, had handed out to everybody, the average days on market, at least for the end of 2022, was 23 days. A residential home was on the market. That is a record for us here in the state, as is the median statewide home value. And that's part of the problem that we're running into. I have many buyers that I'm working with that would like to move into the Lake Sunapee region, predominantly New London, where I live. And an entry-level home to get you into the town in London today is about $500,000. That's a lot of money. Whereas 10 years ago, that same home would have been $250,000, $300,000. So it's a problem that we face, and you know, we don't have all the answers. We're not economists sitting here, even though Chris likes to think he's an economist because he deals with commercial all the time. But we're not economists, and as Bob and Chris will talk today, we do have some information from our chief economist at the National Association of Realtors, Dr. Lawrence Yoon, who we all look at everything he mentions and use some of that. You know, entry-level values in the $500,000 range hurt a lot of people. You know, that young couple that wants to move to New Hampshire, New London area, it's hard for them to get in. New Hampshire is a very desirable state. You know, when the pandemic started to happen, I saw many young people, and younger than I, moving in from the cities, wanting to move to the country. That's New Hampshire, the country. And they had plenty of money, and they were paying cash, $600,000, $700,000, $800,000 in cash to buy a home, because they can now work out of their house. And we're still seeing that happen. However, one of the things that I was talking with Bob out in the hallway before we came in, that I've always said throughout my career is if I see new construction happening, new residential construction, that's what I'm referring to residential, Chris will speak to commercial. If I see new residential construction happening throughout the state, I think things are moving in the right direction. I'm not seeing a lot of that. I recently had a client that bought land in Newbury, New Hampshire, on a very nice property that overlooked Lake Sunapee, an expensive piece of land, but wanted to build. They're not from here. They bought the land, they met with some builders, and found out the average cost to build a nice home in that area was $400 to $500 a square foot. That's a lot of money. You can do the math and figure out what it's going to cost you to build a 2,000 square foot house. He ended up finding a builder from Massachusetts that was willing to come up here and build that for half the cost. So those are some of the other things that, we're facing. The other issue, being in the Upper Valley, dealing with a lot of nurses and doctors that go to Dartmouth. We have many stories from clients, agents of mine rather, that have clients that can accept jobs at Dartmouth, high-paying jobs at Dartmouth, but they can't find a place to live, and or they're living an hour and a half away and accepting that job. So those are some of the real issues that we are up against in real estate today. The other issue is that this is no secret, is inventory. You all have heard it. You've heard it nationally. It's the same here in New Hampshire. We have one of the lowest, if not the lowest amount of inventory right now. I think we're at just over 1,500 residential homes for sale at the end of 2022 in the state of New Hampshire. Now, if you go back, and I'm sure, I don't know if this is on a slide or if they have it in their packet. I think it's in their packet, isn't it? That 2015 maybe, we had 15,000 residential homes for sale at the end of December in 2015. And here we are, 2022, we have just over 1,500. That's not a lot to choose from, even though we've seen home values go through the roof. It's pure supply and demand. So we are working on this on a daily basis, trying to come up with ways as to how we can generate more listings. It's very hard. If I said to each and every one of you, I could sell your house today and make you $500,000 profit, you'd all be very excited. I know Tom would be, because Tom and I are neighbors down in New London and Wilmot. But Tom would say to me, geez, Ben, that sounds great, right? But where am I going to go? If you're going to stay in the New London, Wilmot area, you're going to pay for that on the other end. So why would you sell?
Or you move in with Ben.
Or you move in with Ben. Yep. You have to deal with my wife. So go for that. Right? If you knew my wife, you wouldn't do that. So that is one of the other issues, we are facing is a lot of sellers are saying we don't want to sell right now because where we're going to go, unless they're moving out of state, right? So those are some of the issues that we are facing. Real estate has been a great career for me. I've thoroughly enjoyed it. I love working with buyers and sellers. I'm a native of New London and New Hampshire, obviously. I love selling New Hampshire to people. It's a wonderful state to live in. I'm very proud to Amy and I raise our two sons, and my folks live in Wilmot, near Tom. So it's a great area. It's just very frustrating when people want to come to our area and we can't find them anything to buy, even if they have a lot of money. So it's very, very tough. So with that, I'm going to turn it over to Bob, and he'll start, or whether I don't know, Bob or Chris, and he'll start his PowerPoint presentation to give you some more statistics. So thank you very much, and look forward to your questions.
Good morning, everybody.
Would you take a quick question
Sure,
before we move on?
Please,
Awesome.
please.
Representative Janigian.
Thank you, Madam Chair. Thank you for taking my question. I don't know if this was just a talking point, but you mentioned now $400 to $500 per square foot to build, which we've been hearing, and you gave an example of a young couple, I think, that wanted to build and found that high, and then found a builder in Mass to build it for half the price. How is that possible?
Labor. Yeah, they didn't charge as much in labor costs. You know, we've seen lumber materials come down a little bit, but they apparently they knew this person as well, so they gave him a better deal on the labor is where it really turned out to be. You know, when I talk about that $400,000 or $500,000 square foot home, we've had a lot of builders in the Lake Sunapee region that have had it really good for a long period of time, and they built some places on the lake that they were able to bring those prices up, and it's an unfortunate thing that it's no longer $75 a square foot.
I was hoping that was some sort of reputable thing where we
Right,
could-
right. I
we
don't
would
think
have-
so. I don't
okay,
think so. But thank you.
Thank you. Good morning. So my name is Bob Quinn. I am the CEO of the New Hampshire Association of Realtors, and I'm going to go through some of the statistics and put some of the data into context. I think we've all heard and seen in the media notion that real estate, both in New Hampshire and nationally, is cooling off a bit. And this may not be the best analogy to make today, but it's sort of like saying yesterday was 105 degrees out and now it's 95 degrees out, so it's cooler. Yes, it is, but you got to put it in context. It's still a red hot market. So the first, if I can do this correctly, slide I'll share with you is the New Hampshire Affordability Index. So this is something that we put together to sort of give folks a sense of how much home can a typical New Hampshire citizen afford. And so again, it's so if you had an index here of 120, that means the median household income is 120% of what it would necessary to qualify for the median price home under prevailing interest rates. So the higher the index, the more affordable. We are clearly now at the lowest we've ever seen, and that has been the case throughout the year. So we're down to 73% right now. So that means income is only 73% of what is needed for the median price home. So a lot of buyers simply are not going to be able to afford properties in New Hampshire. And I also want to point out that you'll notice this chart starts in 2005. So this lack of affordability, this slow decline, started about a decade ago. Yes, there was sort of an accelerant earlier this year as interest rates increase and leading to higher mortgage rates. And that has certainly been a contributing factor, but it's probably not the only factor as well to keep in mind. So other contributor, obviously, to affordability as a part to interest rates is the median sale price. Again, same sort of, and you're going to see a theme here, over the past 10 years, there has been a slow, steady increase in median sale price starting just after the recession, about 2012. And keep in mind, for 8 years prior to the pandemic, mortgage rates were pretty consistent, say 3.5%, plus or minus a little bit. But even with that sort of consistency in interest rates, you did see both median sale price increase, and then the next slide is the volume of closed sales. So this is probably one that's most interesting if you're interested in the real estate transfer tax. So this is total value of all property. And the yellow line is single family homes. The blue line is condo sales. Now keep in mind, Chris is going to talk about commercial. Commercial contributes a great deal to the real estate transfer tax as well. So one thing I point out here is throughout 2022, you saw on a month-to-month basis, so we always compare January of 22 to January of 21. You don't want to go January of 22 comparing to February 22 because, as you can see with there's seasonality to real estate. There's more likely to see a greater number of sales in the spring and summer. Wintertime, people aren't as interested, so those decrease, and that's consistent year in and year out. In the past 3 months, you will notice that the total volume of sales has declined. So October was down 10%, November is down about 17%, December a significant decrease down to 25%. And you will notice that in all of these charts, the past 3 months, there's been something that's a little bit different from the previous months in 2022. Whether or not the long-term trend or not, I don't know, but clearly something is happening, undoubtedly related to the interest rates in the economy. Closed sales. So a factor in terms of total volume, yes, median sale prices are increasing, but you'll see here that closed sales are dropping. We saw throughout much of, again, post-recessionary period, year in, year out increases in closed sales. I will point out that in 2020, the pandemic year, it was a record number of closed sales in the state of New Hampshire at 18,474 single-family homes. This past year in 2022, we were down to 14,500 closed sales. That is the fewest closed sales since 2014 in New Hampshire. So there was a significant drop during that time. Question is, how much demand is there still out there for housing? We see prices increasing, mortgage rates increasing. There's still a market out there? Well, Ben alluded to it during the pandemic in 2021. It was not unusual for an open house to see 50, 60, 70 people walk through that house on the first day. Enormous amount of pent-up demand. Does that still exist? So this, I think, is one chart that gets at that, which is days on the market. So this is from the time house goes on the market until not the closing date, but when the property, there's an offer on the property that's accepted. So you can see again, same trend, past 10 years, that's been declining consistently, all right? And now we're down to, in December, it was 32 days. But in this past summer, it was as low as 13 days. Again, sort of record numbers of low. So there's still, as Ben mentioned earlier, it was not unusual to see this number being 90 days, 100 days. So there's still an enormous amount of demand out there. If something goes on the market, it goes maybe not quite as quick as it did in 2020, but pretty close. I think the other factor in all of this is the inventory of homes for sale. And again, same trend, past 10 years, steady decline. Fewer and fewer homes are going on the market. And we have seen that really started to bottom out during the pandemic in 2020. And we've kind of been bouncing in the past 2 years, still historically low levels of inventory, both in the single family home market as well as in the condo market. Some of it certainly is going to be attributed to the fact that individuals, property owners may not want to put their homes on the market right now because they've locked in an interest rate at 3%. So if they sold their home, yes, they're going to reap benefits, larger equity in the home, but they're also now going to be potentially paying an interest rate that's twice as much. That's currently, but you can see previous to the pandemic, the trend was still occurring, that we were seeing fewer and fewer homes in New Hampshire, and inventory is a real problem. Same thing, argument, months of supply. So this chart shows if everything that's on the market right now, nothing else came on the market, everything that's on the market right now were to sell, how long would it take to sell all of that inventory? So we're down to about a month's worth of inventory. A healthy market, not an economist, but all economists will tell you this, it should be between 4 and 6 months. All right, so we are well below that. The past couple of years, we have hit certain months where we had just 3 weeks of inventory. And that leads to the fact that days on the market's declining, demand is there. There just aren't enough homes available to be sold. This chart is just to give you a sense of what's happened the past year. So if you look at it, in January, median sale price was about 14% higher than it was in January of 2021. So you can kind of see month to month in 2022. So the idea here is median sale price each month is still increasing. It's just increasing at a slower rate. And the question would be, are we going to get down to that number being 0 or not in 2023? Next slide is mislabeled, so I'll skip over it. This is really about just demonstrating the past 10 years. A lot of equity has been created in homes, and 2022, what we saw in terms of, again, seasonality is very similar to pre-pandemic years. 2020 and 2021, we saw these wild fluctuations. We don't see them now. I'll also bring up the fact that if you're interested in sort of diving into your own community's statistics, we have that available on our website, nhar.org. nhr.com also works. If you go to the site, it's called Fast Stats, and you can kind of bore down. So I randomly chose Bedford as an example, and you can see how the sale price has changed throughout the past decade or so, and some additional information. And I also randomly chose. I guess it's not there. Is it there? Yeah, and I also randomly chose Laconia to show you as well. So you can see that it'll give you a sense of median sale price, how long something's staying on the market, et cetera. So this is available for most communities in the state of New Hampshire. You can always check on it. If you're interested in boring down into deeper data on your community, feel free to contact myself, and we have access to that information as well. So I guess summarize sort of what we're trying to say here is that, and you heard, I think previously, the difficulty in finding workers we believe is tied directly to the lack of housing options. And I think we just demonstrate how the lack of inventory and housing options for workers exists, and that's a restraint on New Hampshire's economy. We need to work together to try and find solutions. So I'm going to turn it back over to Ben, and Ben can talk a little bit about what he sees happening moving forward. He's going to play the economist.
May we interject? I see a bunch of hands flying. Representative Ames.
Maybe this is going to be addressed, but I'm wondering if you're seeing any change in who's buying the stock, particularly interested in investors who may be essentially converting housing to short-term rental use.
Yeah, so, and I'll let Bob and Chris speak to this as well. You know, for me personally, in the segments of the state that I work in, I have not seen a lot of investors buying single-family homes. Don't have a ton of apartment buildings in the Upper Valley, or excuse me, the Lake Sunapee region. Upper Valley has a little bit more, but we haven't been seeing them changing hands much. So I don't see a lot of investors doing that, at least in my segments. I don't know what these two have seen.
I'm happy to get you some data. Actually, the National Association of Realtors recently just did a nationwide study on this, and they looked at it from every state. Interestingly enough, New Hampshire ranked 50th in terms of investor buyers into the state. The reason for that is a lot of the investors and I'm not just talking about short-term rentals, I'm just talking about larger investors. I mean, they're buying in areas like Texas and Florida, Utah, areas where you can go in, and what they're generally doing is they're finding neighborhoods that still exist where sort of depressed pricing, they see an opportunity, so they buy lower value homes, they fix them up, and then they rent them out at a profit. Those opportunities are not really going to exist in New Hampshire for that type of investment property. In terms of specifics on short-term rentals, happy to try and get you more data on that. If you want to dig into it, there is a really good source called AIR. It's not B&B, it's called AIR DNA, and they track nationally how many people are utilizing their properties for short-term rentals, and so you can kind of see that. I will say that over the past 3 years, it has increased the number. And I don't have a percentage for you. It's not a huge increase, but again, that's going to be somewhat dependent upon your community.
Senator Lane.
Thank you. Thank you for taking my question. So my question is around interest rates. So again, it seems like we were talking about affordable housing earlier, and affordable housing is defined by the cost of the house, the interest rate, and the wage, right? Those are the three components as you figure out what the index looks like. And so obviously we see the velocity of home prices in New Hampshire and what it's doing, and we've seen what happened with interest rates. That's now causing a real bottleneck, and we're seeing, again, we talked about the slowdown in sales happening because no one wants to give up a 4% interest rate for a 7.5% interest rate. What's going to change? What's that looking like? What do you guys see, or what's your crystal ball thinking about for end of 23 and 20 going into 24 and 25?
Sure. Well, my crystal ball will tell you they're coming back down to 3, but that's not my crystal ball. Is really all I do is change one
I
of those.
think that's a bottle, not a
Yeah,
crystal
yeah,
ball.
absolutely. You got that right. Well, a couple things, and I'll mention, like I said, we're not economists, but I'll mention what Dr. Lawrence Yun, our national economist for the National Association, has talked about interest rates. One thing I'll say about interest rates that's interesting, 8-10 months ago, a buyer could have come in and bought a home and got a 3-4% interest rate, right? That's almost like free money for those of us been in the market for a while. However, I'm dealing with buyers today that are saying, okay, we're going to get a 6.5% interest rate. However, they now know in most situations, they don't have to offer $100,000 more on that house to get it now than they did 10 months ago at the 3% interest rate, even though they're at 6 now. So it's not exact science and math, but they understand that they're not paying more than asking price for most situations in residential real estate today. And they know that there is going to be the chance that they might be able to refinance down the road. So some of the buyers that I'm dealing with are thinking that process. They still need a place to live. And they've been talking to their parents, their grandparents, and know that 6.5 is still historically a very good interest rate. Historically, we've been very spoiled in the market in the last few years, where we're in the high 2s, 3s for interest rates. So I'm seeing that happen now. What is the prediction? Well, Lawrence Yun, who we think is a genius in our realm of the world. He's thinking that interest rates have peaked and that he predicts that they will be coming down. He thinks that the eclipsing at late of 2022 at 7%, he thinks that it might settle at 5.7 at some point later this year as the Fed tries to slow the pace of rate hikes to control inflation. So that's kind of his prediction. So if that comes true, it's still not 3 or 4%, but if it's in the 5s, that is really going to be very attractive to a lot of buyers. There still are a lot of buyers out there that still have to get mortgages. One of the things that we have been seeing in the buyer pool relative to getting mortgages is the adjustable rate mortgage. We did not hear about adjustable rate mortgages throughout the pandemic. One, people paid a lot of cash throughout the pandemic. And two, interest rates were so low, for those that know what an adjustable rate is, right? You can't get much lower than 2 or 3%. So the adjustable rate mortgage wasn't even heard of. We joke about this, but we have members that are realtors that are brand new to the industry. They've never even heard of an adjustable rate mortgage, right? So we have to teach them what that product is, that some of their buyers may benefit from it. So we are seeing the adjustable rate being offered by some of our lenders at a little lower rate to get people into the house, to help them out with it being adjusted over time. Now you'll see this slide. This is from the National Association, Dr. Lawrence Yun. So you can see the years that he has there, what his forecasts are for unit sales in 2022, 23, and 24, and what he thinks the home prices may do, as well as dollar volume. So, he's very optimistic about what's going to go forward here. Now, this is on the national scale. I'm a firm believer in our state, and I hope that these are a little more positive than the national scale looks for New Hampshire, because our values have always held strong here in this state, and I think they will continue. So I'll turn it over to either Bob or Chris, whoever wants to start now.
Certainly. So, grab this microphone. My name is Chris Norwood, and I'm the commercial broker here on the panel. And you may see me from time to time in these hallways. I am also the public policy chair, at least until they kick me out. So I thought I would at least define commercial real estate as I work in it. And so everyone in this room knows is I am part of the New Hampshire Association of Realtors, which predominantly focuses on residential, but also we have about 250 members that focus exclusively or primarily in commercial real estate. And as I define commercial, the primary food groups are the office market, the industrial market, and the retail market. And then you can also look at the investment market, be that a triple net leased CVS or a multifamily investment or a specialty use product like a hotel, motel, gas station, etc. So historically, and I don't have the pretty graphs because commercial data is not as transparent. So when you go to sign a lease for a building, it's great that if I can capture that data so it helps me with my next opinion of value, or an appraiser helps it with their next valuation. But leasing data is hard to come by. And on the sale data, there is some trends that we can follow, but it's not as transparent. You need a lot more data to really to talk about that. But I am happy to answer any questions in that regard. So starting back in 2020, there was the shutdown, right? So if you look at the second and the third quarters of 2020, we should have gone on sabbatical, right? There was no properties to transact. The phone wasn't ringing. People were in the office market, were really trying to do what we refer to as blend and extend. They were trying to extend out their lease rates, seeing that there may be a decline in the leasing environment. But a lot of the thinking in that time was maybe ill-formed, because starting in the third and to fourth quarter of 2020, and then for about 6 to 7 quarters, as Ben said, it was pretty good business to be in commercial real estate. So where are we right now, and where are we going? So if we look at the major food groups and we talk about things like the cost of construction and the impact of interest rates, I'll just go through them real briefly. I think the office market, our employees, as we look at ourselves as a state, where are we? I think for the most part, New Hampshire, as opposed to larger cities like Boston, are doing a better job inviting folks back into the work environment. That has continued to bolster the office market in New Hampshire. Are there segments of the economy and segments of the business community where people are less likely to go back? Absolutely. When you have a large office building of a single tenant of hundreds of thousands of square feet, and you have multiple employees that can share desks in that environment, I do believe their real estate footprint is going to shrink. But if you're talking about the local real estate office or a local attorney's office or engineering, those people are still coming back because they're smaller offices, typically in New Hampshire. And unlike Boston, we're not asking employees to fight 93 for an hour and a half each way. It's a different invitation back into the market. So I do think there's going to be a softening in the office market, but perhaps not as dramatically as some of our neighbors. If you look then at the retail market, retail has continued to strengthen. And we saw this in the early 2000s. And I don't mean to be doomsday, because obviously there was a cliff there, but a lot of retail is predicated on interest rates. And as we see interest rates climb, we have to be cognizant that credit card rates climb. But what we've seen now that didn't happen in 2007 before the Great Recession is the adaptive reuse of a lot of retail facilities. So if you notice, retail now is no longer where I go to just necessarily buy my groceries. There's what we refer to as experiential retail. And I think that cities and towns and us as a state needs to think about what that means. I take my kids out, we go to a bouncy house, and that is our afternoon. Then we go and get coffee next door and an ice cream on the way home. So that bouncy house or that education facility or that insert your experiential retail here is an adaptive reuse of something that was initially thought to be a grocery store, but now it is something else. And I think that that trend is going to continue. The next piece to talk about briefly is the strongest part of our economy relative to real estate, which is the industrial sector. So Ben, you were talking about history, and so I've been in real estate now. I think I got licensed in 2000, 2002, somewhere in there. And for most of my career, how much does it cost to rent an industrial building? I don't know, $5 to $6.50 a square foot, day in and day out, day in and day out. Now that same building is pushing into the low double digits. And if you want new construction, which by the way, new construction needs to be high bay, meaning 24 foot higher, or sorry, 20 foot clear or higher, those buildings you're renting out now for double digits. And it's the only way an investor or in some cases an owner occupant can justify the cost of new construction because construction, steel, labor is so high. Not to mention just the added cost of code to build these buildings has been increasing over the years. But let's stay with the positive. Industrial continues to be strong. And that is, I think, directly correlated to the challenges we've seen in the last 2 years. I was at a meeting this morning with a manufacturer who said, I need warehouse space. I am not going to risk my business like I have in the last 24 months to supply chain. I need to know that I have, in this case, he wanted a seasonal business. He wanted to have at least 12 months of inventory in his own warehouse that he could touch if there was ever another supply chain issue. So I do think that we do exist in a broader political environment where people understand what's happened in the last 12 to 24 months relative to supply chain. And on the industrial side, manufacturing and warehouse, that's where we're seeing the increase. That's for the larger buildings. There are still a lot of smaller industrial that, again, continue to be strong. I share Ben's view that when I see single-family home constructions, what I see are title companies, mortgage companies, plumbers, electricians that are helping put those homes on the market. And I do think that if there is going to be a slowdown in the economy, I am concerned about the smaller, what we refer to as the contractor industrial bays. So that plumber who has 6 trucks and is right now has just been putting those people out all day long, are they going to continue to have the income to pay their condo fees, to pay their real estate taxes and so forth, because they've just been going I mean, I can't get a plumber. I mean, God forbid any one of us has a sink burst. But that's how I view the office industrial retail market. Lastly, I do just want to touch upon the investment market because I do think it goes to the question about interest rates. So the investment market, where that may be anything from a 4 to 6 to 12 unit apartment building, or whether it's a larger mall, retail building, or a single tenant leased office or pharmacy. The largest single change that I have seen in the last 6 months has been the, I don't want to overstate it, but the, I was going to say exodus of investors, but I think that that's too strong. The movement by investors away from real estate, not 100%, but what they're saying is sellers are still pricing their assets at a 3% interest rate, and investors are coming in and borrowing 7%. And there's no more room for an investor, or in some cases, developer, if I'm going to build a new building and lease it out to tenants, that developer, that investor, that profit margin is now taken by that growth in the interest rates. Quick math I did yesterday was on a 20-year mortgage, which is traditional for commercial real estate. The buying power for every $100,000 of buying power that you had 6 months ago, you now have $81,000 worth of buying power with traditional rates. Now, the bright side, I like to think somewhat optimistically, is that real estate investors, real estate developers do not have the same horizon window that single-family homeowners do. My wife and I just renovated our house, and that's going to be the house, knock on wood, that we're going to raise our 4 kids in. But most commercial folks have a 5-year balloon on their interest rate. So they're thinking of, okay, I'm going to lock it in, and it may be 10 years, right, depending upon it, but they're looking at a declining real estate interest rate that they foresee forecasting coming up in the next 5 years. So I do think that there is some positive news that some investors are doing this, they're holding their nose, they're taking the 7% interest rate in the thought that things will be at a point that they can refinance some cash out in a number of years. But again, holistically, industrial is leading the market. Interest rates have really pushed investors, particularly on the apartment units, to the side, whereby we are seeing more owner occupants, particularly on the commercial side. The industrial users, they're saying, I want to buy. I know the interest rate's 7%, but darn it, I need that building because I don't want to be impacted by the supply chain. So happy to entertain any questions on that as well.
Senator.
Madam Chair, if there's an economic downturn, what do you see as the chances of us having another foreclosure crisis as we did in the last recession? Is it high, or have there been enough structural changes in how much of a purchase homeowners can finance?
Well, just from from our economist relative to that, what his prediction is that he predicts foreclosure rates are still going to be very low nationally. Less than 1% of all mortgages is what he predicts for 2023. So I don't think we're going to see too much of that here in New Hampshire. We obviously had the meltdown crisis that we all remember, but over the last few years, I haven't really seen that much, and I don't think that that's going to happen much, and nor does Dr. Lawrence Huang. Bob?
Yeah, just add it, prior to the Great Recession, as often referred to, I hear from a lot of realtors, if you had a pulse, you got a mortgage, no matter what it was. It was very simple to get a mortgage. Structural changes have occurred, and that's no longer true. So you don't have people who are basically putting down no money for a $400,000, $500,000 home that suddenly is valued at $300,000 and they're underwater and go into foreclosure. So that's not the case. And in the past 10 years, if you see the median sale prices have increased, enormous amount of equity has been built up in those property owners. So, if you bought a home in 2019, you're doing pretty well right now in terms of how much equity has been built up in that home. And I think that's going to change. And that's something in New Hampshire, which maybe isn't the case everywhere in the country.
And I'll just say lastly on the investment front, and I said I wasn't going to get too statistical, but prior to the Great Recession, you saw average per unit multifamily sales be somewhere around $80,000 to $100,000, and then decline down to $40,000 or $50,000 in the Great Recession. And I can say from personal experience that I was doing opinion of values in the Great Recession, driving around in Manchester, Nashua, and the lenders whom were my clients never set foot in the state. And there was a lot of cash chasing investors that wasn't the best underwriting. I think the underwriting that I've seen in the last decade, particularly on the multifamily investment side, has been a lot stronger. So that gives me a little bit more hope where we're going.
Great news. Thank you.
And I'll also just mention that we can talk about, as we're looking at where the housing market in New Hampshire is going, inflation rates, mortgage rates, wages, general health of the economy. But those economic data points can't be the only reason for the decline in inventory, because we've seen this steady decline over the past decade. So there is something, that 800-pound gorilla, I guess, is sitting here, which is we as a state are not creating enough housing supply, enough housing stock to meet the demand. It is decreasing, and it's, I think, still in a very a crisis level when you're talking about only a month worth of inventory available. So, I was talking to Ben earlier on in his neck of the woods. There's a municipality up there that has taken the challenge of housing seriously, and they are doing all sorts of creative things, both with apartments, single-family homes, and other ways, because their businesses, their local businesses, are demanding it, indicating we cannot find employees, and when we do, they sometimes will accept the job, but then have to decline because they cannot find an adequate home. So we have some municipalities who are taking that very sincerely. That same municipality I was talking to there, someone who worked for that that municipality, he said the problem is the towns around us have pulled up the drawbridge, and they are not permitting anything from being built. So it's all on our shoulders. We all value local control. That's the way things are done in New Hampshire. But we would also suggest to you as public policy makers that there is a role for the state to play in all of this, or else you're just going to have, when does one town's local control start to impact another town's ability to control their local control, their borders, if you want to add anything.
Representative Jinigan.
Thank you, Madam Chair. I don't know who wants to answer this, but we certainly know that there's a lack of housing in New Hampshire. It's a huge problem, and we need to figure out how to address it. Is New Hampshire, how unique is New Hampshire in this, or is this a problem across the country?
So it's a problem across the country, but it is a bit more acute here in New Hampshire. And I think probably it's hard to compare New Hampshire to Colorado. It's a lot easier to compare New Hampshire to Maine. So if you look at Maine in terms of month supply inventory, they have more inventory available. I don't have the data right in front of me. You know, if we're at 1.2, they're still in trouble, but they're at 2.5, 2.6 or something like that. New Hampshire always had a bit of a advantage in many ways over Massachusetts, especially that northeastern corner of Massachusetts. The value of median sale price was always a bit, so it was more affordable. That's not quite the case anymore. I was looking at Massachusetts data this past week. In Rockingham County, your median sale price for the county at the year end was $550 or something. It's in your packet. That's pretty much what it is in Northeast Massachusetts as well. So we've kind of caught up to them. And speaking of Rockingham County, the total number of homes that were sold, single-family homes in Rockingham County, only 10% sold for less than $400,000 last year. So the vast majority of properties in Rockingham County are being sold for $500,000 and above. It's going to impact your first-time home buyer. You know, that's a very challenging thing for someone to do. I will also bring up, and I met someone recently who mentioned this to me. They were a retiree. They were living in a community, and they just retired. They had to downsize. Can't find anything in their town that they can afford. And so he's like, listen, I've grown up in this town. I've lived in this town all my life. I have to move. I have to leave the town because there's nothing available for me. So that's a real problem as well.
Senator Murphy.
Thank you, Madam Chair. My sense is that of the many, many factors that are affecting the housing market and driving it to such a situation, that the influx of people we had from other states during the pandemic was a big cause. Is there any indication that they're leaving? Has there been any buyer's remorse, or are they should we plan for them to stick around for the next, 20 years? Thanks.
So yeah, that's a great question. Being from New London, small little town, we don't even have a stoplight in New London, but in the summertime when it takes me more than 10 minutes to get from the post office to the college, as Tom knows, I'm ready for all of them to go home, meaning the summer folks. I'm not sure if they're leaving. One thing I can tell you is I know being on the school board in the Kearsarge Regional School District and having a good friend that is on the Sunapee School Board, a lot of families actually moved up during the pandemic and enrolled their kids in our school districts. Our numbers went up a little bit, as did Sunapee's, and they're staying. They're not leaving. You know, they had another house up here already, and this is their primary residence now. So I don't see a lot of people moving out. Once again, you know, I sell the New Hampshire experience to people, and a lot of people want to live here. And the other thing also is because of what happened throughout the pandemic, you can work from home now. Why would they leave? Why would they leave?
I think just one piece of data. So as Representative Sanborn mentioned, I also serve as the chair of New Hampshire Housing Finance Authority. Ben Frost and his team from New Hampshire Housing had done some research in 2021, and I don't know if they captured that same data in 22. But what they did is they looked at all the transfers in historic years to find out typically how many transactions happen from New Hampshire sellers to out-of-state buyers. And again, I don't have the data for 2022, but I share it from the increase from 2020 to 2021 was only around 2% from an increase of out-of-state buyers. And so I suggest that to say that I do think that the out-of-state folks are mostly in line of what Ben is saying, is where there were already folks who had a second home and they're moving here. The people who are buying in New Hampshire new, I think, have got a lot of media attention. And I'm not saying that they're not there. I just don't believe that the statistics say that they are the only reason for the increase in housing prices.
I think those stats were somewhere in the vicinity of about 70% of all transactions are New Hampshire residents moving to another home in New Hampshire. So 30% would come from out of state. When it changed during the pandemic, maybe it went down to 67.
Senator Lang and then Representative Bolton, please.
So I'm sorry, I just want to follow up on that, this conversation. So are you saying that we there's no data point to capture because they already owned a home and they may have made that now their primary home, and so there's no housing data point to capture? Is that your?
Yeah, for the subset that Ben mentioned, which are folks that were already had a second home that moved up here, I think the data to capture, and I spoke with folks anecdotally, is if you looked at school enrollment records from 2020 to 2021 in communities that are predominantly vacation communities, you saw upticks in those areas. But you wouldn't necessarily capture that subset, i.e. people who already owned a home, in any transactional data.
Thank you, Madam Chair. This is going to be a quick one, but regarding that town or city that is doing creative things for housing solutions, can you share that?
I never I think there are clearly some communities which have met the housing challenge in a way that's sincere. And I don't, it's hard to point to each community because then you forget one and someone says, well, I mean, I think that places like Exeter and Lebanon are making real attempts to, and there are others too. I'm not in Dover, and there are plenty of others. But I do think that the overall point is some communities are doing this and others are not. And so then the question becomes, is there a state role to play to ensure that, hey, looks, and everybody's got to participate in this in order to meet this affordability problem?
And if I could, there are a couple quick solutions too, like exchanging of development rights. If you take land that you would otherwise put into conservation and exchange what could be developed on that land into an area that already has municipal water and sewer, maybe that's a solution that could be a uniquely New Hampshire solution that we could offer to municipalities.
For the Senate members who are here, the Speaker created a special committee on housing to try to really drill down on this. So hopefully you will participate in whatever they're doing there. I saw a hand on this corner. Did I not? No. Any other hands for questions? Representative Janigian.
Thank you, Madam Chair. I think this message is for Chris. This question is for Chris. You had mentioned that the multifamily market, I think pre-Great Recession was about 80 to 100K per unit, dropped to about 40K per unit. What is it now?
For the class, B wood frame stuff, it's probably 100 to 115, 120. For the class A stuff where there's a nice lobby and, the above a builder grade, you're talking many, many higher multiples because it goes back to that cost of construction. So I can put on my New Hampshire Housing Finance Authority hat and I can say that, to build new construction nowadays, it's $300,000 per unit, all in, land, soft costs, et cetera.
Thank you.
Guys, I know everyone's eager to get to lunch, and we're the last, I guess, of the 2 days. So, but just to sort of wrap up in terms of getting into some of the questions regarding, how do we improve inventory in the state and bring down affordability, we do have to take, and we have reached out to, and we've had a lot of conversations with municipal leaders in terms of some of the challenges that they face, land use boards, what are they hearing from their residents. And, one of the contributing factors, certainly not the only, is a concern by some communities have is, hey, if I build more housing, then that means we're going to see more school-age kids come into my community. Those school-age kids are then going to go into my school, and I'm going to have to pay for them. And so therefore, my taxes are going to go up if more kids come in. So several years ago, we looked at this issue. We actually brought in an economist from the University of New Hampshire, and he basically just went through every single town in New Hampshire, looked at what their education tax rates have been over the past decade and what their enrollment, and try and find a correlation to it. With your indulgence, we actually have a quick 5-minute video that if you are willing to watch, and then this will kind of explain it a little bit, but let me see if I can.
It's a familiar concern. If the town allows for more housing, school-age kids will follow, and educating those kids means property taxpayers will pay more. But is it really true? Do additional school-age kids actually lead to property tax increases? The question is critical to New Hampshire policymakers at the local and state level because reluctance to educate more children is likely leading to the state's growing housing affordability crisis.
It seems to be believed, at least in some circles across the state, that if you build more housing in a town, and that brings families with children into town, the additional school enrollment will raise local property taxes. That belief, I think, is an impediment to building more housing, more affordable housing for younger families across New Hampshire.
Professor Richard England, former professor of economics at the Peter T. Paul School of Business at UNH, reviewed school enrollment data and education property tax rates from over 200 New Hampshire cities and towns in an attempt to determine if more kids in town inevitably leads to higher property taxes.
My research found that it simply isn't true. One cannot say that if you bring more children into town and they enter the public schools, that the property tax will go up. It simply isn't supported by the data or by logic. The school administration costs could stay roughly the same. Does debt service on the bonds that were issued in past years go up? No, the cost of debt service stays the same. If enrollment goes up, not all parts of the cost side of the budget go up in proportion. Do even transportation costs go up? School transportation costs? Probably not. Because there often are empty seats on school buses. And if you have more enrollment, you just put more kids on the existing buses. So it's not the case that if more kids come to town, that the costs go up by the average cost of educating the kids who are already in the district.
In virtually every community across the state, the number of students enrolled in public schools has been steadily declining. In fact, prior to the pandemic, of the state's 234 municipalities, only 29 communities experienced growth in school enrollment in the previous decade, while more than 200 saw school enrollment decline. So as school enrollment has decreased, have property taxes in towns dropped? In fact, the opposite has been true in many cases, as towns have seen a steady increase in tax rates, even as school populations have declined.
If you look at the decade just before the onset of COVID,
and what's happened to class sizes, what you find is that in a large majority of school districts across the state, class size declined. What you find when you do that data analysis is that there's almost no correlation at all between enrollment percentage changes in enrollment and changes in the school tax rate. Yes, there are examples of communities where enrollment went up over a 10-year period and the school tax rate went up. But there are also plenty of examples of communities where enrollment went down and the school tax rate went up.
Of the 11 largest school districts in the state, Dover, for instance, saw substantial growth in its student population, yet had a smaller increase in its school tax rate than 6 of the largest districts with declining student enrollments. This provides some preliminary evidence that student enrollment is not the primary driver of the local tax rate for public schools. The largest increase in school tax rate came in Salem, a town that experienced a nearly 20% decline in the number of elementary students during the decade. In fact, only 7 communities in New Hampshire experienced both a decreased school enrollment and a lower school tax rate. And many communities which saw the largest drop in students also experienced the largest increase in their school taxes.
The issue of construction of workforce housing and the impact on the tax rate is an important one, and I can understand why many town officials and town residents are asking this question. But I think we have to look into the data. We can't just assume that if we enroll more kids in the schools that the tax rates will go up. And to assume that is to guarantee that we're going to continue to have a housing affordability problem in New Hampshire.
So what are the long-term implications for a town and a state with fewer kids? After all, working age people generally have school-age children. If the public policy position of a municipality is to keep children out of its community by limiting the housing supply, it should logically mean that it will also have fewer working age residents. Without those workers, employers will not have the employees to expand and help to grow New Hampshire's economy.
Representative Elberger has a question.
It's actually just a procedural kind of question. Thank you, Madam Chair. Is there any way we can get copies of this? I would love to be able to present this to our Board of Aldermen.
We'll send it out to everybody. It is also on our website front page, along with all this data.
Thank you, Madam Chair.
Yeah, all of these presentations should be on the General Court website, and there is a link in the email you received from Jennifer Four. If you need help with that, please see Jennifer, who's around here somewhere. There she is. Okay. Excellent presentation. Thank you very much. Thanks
Thank
for
you
three of
having
you
us.
coming.
We appreciate it.
Wonderful. Folks, we are done for today. Great job. Awesome attendance and involvement and participation. So we'll wrap it up for now. Drive safely home. And I know I'll see my House Ways and Means members on Tuesday. Monday, the State House is closed. Thank you.
And just a reminder, the Democrats are not done for the day.